Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, welcome to The Explainer. Today we're diving into a question that honestly could be the difference between building real wealth and, well, losing your shirt. And the question is this: are you an investor or are you a speculator? To figure that out, we're going straight to the source, to the man who literally wrote the book on it, the great Benjamin Graham. So, to get our heads around this, let's just hop in a time machine for a second. Let's go back to the late 90s. I mean, if you were around then, you remember this stuff. The dot-com boom was on fire, and TV commercials like this were everywhere. The message was simple, right? Getting rich is easy. It's fast. All it takes is a computer, a mouse, and a few clicks. And this feeling, it was everywhere. It wasn't just in the ads. You had celebrities openly talking about their stock trading like it was a new workout routine. The market had completely transformed. It wasn't about owning a tiny piece of a great American business anymore. Nope. It had become this giant national video game, and the only objective was to keep your score, your P&L, in the green. And here's the crazy part. We were drowning in information. You had financial news on 24/7, stock tickers scrolling across the screen, websites giving you real-time quotes, so much data. But actual knowledge? Man, that was hard to come by. Stocks just stopped being businesses. They were just ticker symbols, these abstract little blips on a screen. And as long as your blip was going up, who cared about anything else? And, well, this is what happens when the party ends. This is the hangover. By the end of 2002, this number, minus 95%, was the reality for a whole lot of those dot-com darlings. Now let's be clear, a loss like that is an absolute catastrophe. Just to get back to where you started, you'd need a gain of 1,900%. It's basically game over. And if you want a poster child for this madness, look no further than this. Linux. I mean, wow. On its very first day of trading, the stock shot up almost 700%. People thought they'd found the golden ticket. But fast forward just 3 years, the stock is trading for $1.19. Anybody who chased that rocket got completely incinerated. This is what it looks like when pure speculation wears an investing costume. So, if that's the road to ruin, where's the map to success? How do we find any logic in all this chaos? Well, for that, we need a guide. And we're going to turn to a man who learned all these lessons the hard way, through brutal first-hand experience, Benjamin Graham. You see, Graham's ideas didn't come from some ivory tower. This guy's wisdom was forged in the fire. He got duped by a hot stock tip way back in 1919 and watched it go to zero. Then he got nearly wiped out in the great crash of '29, losing almost 70%. But, and this is the important part, out of that absolute wreckage, he built a logical, disciplined system that not only made him a fortune, but has basically been the foundation of smart investing ever since. So, what was his secret sauce? How did he do it? Well, it wasn't just one magic trick. It was a whole philosophy, a complete framework for thinking. He took everything he'd learned and boiled it down to a few powerful rules. We're going to dig into 3 of the absolute most important ones. First things first, Graham was obsessed with using the right words, and he started with the most important one. He laid out a crystal clear definition. For something to be an investment, it has to meet 3 tests. 1, you've done thorough analysis. 2, you can reasonably expect to keep your original money safe. And 3, you're aiming for an adequate or satisfactory return. Notice he didn't say spectacular, just adequate. If you're missing even one of those, guess what? You're not investing. You are, by definition, speculating. Period. Now, that one little definition creates 2 totally different universes. The investor, they're like a business analyst. They're trying to figure out what a company is actually worth. They think like an owner. So when the market drops, to them, that's a sale. It's a buying opportunity. The speculator, on the other hand, they couldn't care less about the business. They're a gambler, betting on which way a squiggly line on a chart is going to go. And for them, a market drop is just pure gut-wrenching fear. Graham had a really simple way to think about this. He'd say, look, you can drive your car at 130 miles an hour. And hey, you might get where you're going a little faster if you get incredibly lucky. But you do that day after day. It's not a matter of if you'll crash, it's when. Speculation is driving 130 miles an hour. Investing, that's like setting the cruise control at a sensible speed, knowing that you're actually going to make it to your destination in one piece. Okay, so this brings us to his second big rule, which is the key to driving safely. It's called the margin of safety. Graham himself said these were the 3 most important words in all of investing. And all it really means is this: You only buy something when the price is significantly less than what you've calculated it's actually worth. It's your buffer. It's your cushion for when you're wrong or for when bad luck just happens. The analogy of building a bridge is just perfect, right? If you know 10,000-pound trucks are going to be driving over your bridge, you don't build it to hold exactly 10,000 pounds. That's insane. You over-engineer it. You build it to handle 15,000, maybe 20,000 pounds. That extra capacity, that buffer for the unexpected, that is your margin of safety. You have to build it into everything you do as an investor. All right, Graham's third great idea is my absolute favorite. It's not a formula or a ratio. It's a story, a mental model to help you deal with the sheer craziness of the market. He wants you to meet a character he invented. His name is Mr. Market. So here's the setup. Imagine you're partners in a business with this guy, Mr. Market, and every single day he shows up at your door. The problem is, the guy is a total emotional basket case. He's manic-depressive. Some days he's euphoric, practically giddy, and he offers to buy your shares from you for way, way more than they're worth. Then, other days, he's in the depths of despair, totally panicked, and he offers to sell you his shares for pennies on the dollar. Now, here's the beautiful part. You have a choice in how you deal with this lunatic partner. You can let his moods become your moods. You get greedy and euphoric when he is. You get terrified and panicked when he is. If you do that, he's your master. Or you can treat him like your servant. You can use his irrationality to your advantage. You happily sell to him when he's offering you a ridiculous price, and you gladly buy from him when he's practically giving his shares away. And this is the absolute key to the whole story. Mr. Market is there to serve you, to offer you prices. He is not there to give you advice. And most importantly, you never, ever have to trade with him. You can just shut the door and ignore his screaming and yelling for days or weeks or months until he finally makes an offer that is so obviously good for you that you decide to act. You are in control, not him. So, you put these three big ideas together, investing versus speculating, margin of safety, and Mr. Market. What do you get? Well, you get a completely different way of thinking about risk, a total paradigm shift. It turns out the biggest danger isn't where most people think it is. And listen, the proof is in the results. This wasn't just some academic theory. Graham's principles created a whole school of massively successful investors. Warren Buffett famously called them the super investors from the intellectual village of Graham and Doddsville. And the thing is, their long-term track records are so good, they simply cannot be explained away by pure luck. Something else was going on. This quote from Buffett talking about his friend Walter Schloss, another Graham disciple, just nails the mindset. What was the common thread? It wasn't about trying to hit home runs. It was this deep, powerful, strong aversion to loss. Their number one goal, always, was the disciplined avoidance of losing their capital permanently. Everything else was secondary. And that brings us right to the heart of it. This is the core lesson of Benjamin Graham's entire life. After all the math, all the analysis, all the rules, he came to this profound conclusion. The greatest risk you will ever face as an investor is not a stock market crash. It's not a bad economy. The greatest risk is staring back at you in the mirror. It's you. It's your own behavior. Let me put that another way, because it's so important. Real financial risk isn't about what you own. It's about who you are. Your portfolio isn't safe because you own safe things. It's safe because you are a safe, disciplined, and rational investor. You have to master yourself before you can ever hope to master the market. So we end with the challenge that Graham lays down for every single one of us. Every day, Mr. Market is going to scream a price in your face. But only you, through your own work and your own emotional control, can determine the underlying value. The speculator follows the price. The investor is guided by the value. And so the question he leaves us with is simple. Which one are you going to be? All right, let's dive into one of the most fundamental ideas in all of finance. And, it's one that's become dangerously confused. The real difference between investing and speculating. It's a line that's gotten so blurry that getting it wrong can literally cost you everything. So let's make sure that doesn't happen to you. Now, you might be thinking, why on earth are we starting with a philosopher from the 1600s? Well, it's because Blaise Pascal absolutely nailed the core problem of our modern markets. All that constant noise, the flashing tickers on the screen, that gut-wrenching feeling that you have to do something right this second. It all preys on our basic inability to just sit still and be patient. And that impulse? That's exactly where speculation thrives, and where so many fortunes are lost. So let's get right to the heart of it. The thing is, over the last few decades, Wall Street's language has gotten, well, really sloppy. The word investor is just thrown around to describe pretty much anyone who buys a stock, for any reason, for any amount of time. And this isn't just about words. It's a really mischievous misuse of language that has led countless people down a very, very risky path. And this timeline, wow, it just lays it all out, doesn't it? If you go back to 1973, the typical shareholder held a stock for about 5 years. That's real ownership. Now, let's fast forward to 2002, and the average hold is less than a year. And at the absolute peak of the dot-com bubble, some of those NASDAQ stocks were being held for less than a week. It just stopped being about owning a piece of a business and became more like a high-speed video game. And look, if you want proof of just how completely disconnected things got, get this. This isn't a joke. I mean, this actually happened. Back in 1999, a company called Juno Online Services actually announced a business plan that was, for all intents and purposes, corporate self-destruction. Their big idea was to offer their services for free and just pour millions into advertising with the stated goal of losing as much money as they possibly could. And this just perfectly captures the madness of that time. What was the market's reaction to this suicidal business plan? Well, it sent the stock soaring. It went from about $16 to nearly $67. The company's actual value was completely, totally irrelevant. The only thing that mattered was the ticker symbol and the fact that the price was going up. This is speculation, pure and simple, totally unhooked from business reality. Oh, and the absurdity? It didn't stop there, not by a long shot. In this classic case of what you might call financial dyslexia, thousands of traders were frantically buying up shares in a small building maintenance company, Temco, ticker TMCO. And why? Because they thought they were buying Ticketmaster, ticker TMCS, an internet darling that had just gone public. Think about that. They didn't even know what company they were buying. All they knew was that a ticker was moving up. That's it. Okay, so with all this chaos flying around, you need an anchor, right? You need a clear, timeless principle to guide you through the storm. And for that, we turn to the man himself, the father of value investing, Benjamin Graham. You see, he saw all this confusion coming decades ago and gave us the tools to navigate right through it. And that brings us to the big question, the one that really matters. When the market starts to feel like a giant casino, and it seems like everyone is just betting on tickers, how are you supposed to tell the difference between a wild gamble and a real investment? What does being an investor actually mean? And this is Graham's answer. It's so simple, but it is so, so powerful. I want you to read it carefully. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. See, anything that doesn't meet all three of those requirements is, by his definition, speculation. Full stop. So if you really look at that definition, it breaks down into 3 simple, clear pillars. Pillar number 1, thorough analysis. You have to do your homework. You have to understand the business you're buying. Pillar 2, safety of principal. You must deliberately, actively protect yourself against a serious loss. And number 3, an adequate return. The goal here is satisfactory, not mind-blowing performance. If you break even one of these rules, you're not investing anymore, you're speculating. So, with that definition in our back pocket, we now have this amazing framework for understanding 2 totally different kinds of people in the market. And it's not about how much money you have or how smart you are, it's all about your mindset and the method you use. So here's the absolute bottom line, the crucial difference. The investor looks at the business first to figure out what a stock should be worth. The market price is just a data point. But for the speculator, the price is everything. They couldn't care less about the business, they only care that someone else, some greater fool, is going to come along and pay more for the stock down the road. You see, the investor aims to master the market. The speculator is basically a slave to it. Okay, so it's just human nature, right? We're always looking for a shortcut, an easier way. And you can bet Wall Street is always, always happy to sell you one. These so-called magic formulas promise these incredible, market-beating returns with almost no effort. And let me tell you, they are an incredibly tempting speculative trap. I mean, check this out. In the mid-90s, a book called What Works on Wall Street made this just jaw-dropping claim. It said a simple mechanical strategy could have generated over 18% a year for 4 straight decades. The promise was just irresistible, wasn't it? Just follow this simple formula, and you get rich. But, and this is a big but, here's what actually happened after that formula got published and turned into real-world mutual funds. Over the next few years, the S&P 500 gained over 82%, and the funds using that magic formula, well, they got absolutely crushed. It's a theme you see again and again. The very moment a simple formula gets popular, it often just stops working. And it wasn't a one-off. Here's another one from the late 90s. A strategy called the Foolish Four became super popular online. It promised to completely crush your mutual funds in just 15 minutes a year. And here's the most important part. It claimed to do it with minimal risk. That's always the hook, isn't it? High returns, low risk. Who could possibly say no to that? But hang on a second. Let's use a little common sense here. A key part of this Foolish Four formula was to put 40% of your entire portfolio into a single stock. Now, I have to ask you, does that sound like minimal risk to you? How on earth does that line up with Graham's pillar of safety of principle? It doesn't. It's a high-risk gamble dressed up to look like some kind of sophisticated strategy, and it just throws the most basic rules of investing right out the window. All right, so we've talked a lot about what not to do. Let's shift gears and talk about the constructive path forward, because Graham provides a simple, a clear, and a truly prudent blueprint for anyone who wants to invest intelligently without turning their life into a stressful marathon of watching screens all day. So for the defensive investor, and let's be honest, that's most of us, Graham's advice is just timeless. He says to maintain a simple 50-50 split between a diversified basket of stocks and high-quality bonds. Now, this isn't just about the numbers. It's like a psychological fortress. Your stocks are the engine for growth, while those bonds act like a shock absorber, protecting you from panic selling when the market inevitably takes a dive. But here's the thing. Graham wasn't a total Puritan. He understood that the gambling instinct is just, well, it's human. So he gives you an outlet. He says, fine, if you absolutely must speculate, go for it. But, and this is key, you have to wall it off completely, capping it at a maximum of 10% of your total investment money. And this is non-negotiable. You have to follow some very strict rules with this mad money. First, you keep it in a completely separate account, both physically and mentally. Second, you never, ever add more money to it, especially not if you get lucky and go on a hot streak. And most importantly, you must never fool yourself into thinking this is investing. It's a gamble, plain and simple, and you have to be 100% prepared to lose every single penny. You know, when you boil it all down, this whole conversation leads to one single conclusion. The biggest battle you'll ever face isn't with the market. It's not about finding the next hot stock or trying to outsmart Wall Street. The real challenge is the one right inside you. You gotta love this quote because it is just so painfully true. Fads, formulas, and sheer foolishness are a permanent part of the financial landscape. There will always be a new, dopey idea promising you easy riches. Your best defense isn't some complex algorithm. It's having a solid intellectual framework and honestly the guts and the discipline to actually stick with it. Look, at the end of the day, nobody, and I mean nobody, can predict what the market's going to do tomorrow, next week, or next year. But that's not the question you really need to answer. The real question is about control. Will you let market chaos, the talking heads on TV, and your own worst impulses dictate your financial future? Or will you, as an intelligent investor, take control yourself? The choice, as always, is yours.
Welcome to The Explainer. You know, there's this hidden tax, one that silently drains your savings, your retirement accounts, every single day. We're talking about inflation, of course. Today, we're going to peel back the layers on this really complex and honestly often misunderstood relationship between your investments and this constant economic pressure.
You know, this old joke from comedian Henny Youngman, it kind of hits a little too close to home, doesn't it? I mean, we've all had that feeling at the checkout counter, and it just perfectly captures what inflation really is. It's not that the groceries are heavier, right? It's that every single dollar in our pocket is getting lighter. Figuring out how to stop that value from just evaporating, well, that's really the core of intelligent investing.
Okay, so here's our game plan for today. First, we'll tackle something called the money illusion. Then, we're going to bust the myth that it's all about stocks. We'll look at when stocks can actually fail you, talk about some modern tools to fight back, and finally, put it all together to build a resilient portfolio. Let's get started. All right, first up, inflation's money illusion, or what I like to call the hidden thief in your wallet. We really need to get our heads around why inflation is so, well, deceptive. It plays these little tricks on how we perceive our own wealth, and that makes it a really quiet but serious threat. So let's pull back the curtain on this bias that honestly makes all of us a little bit vulnerable. So what is this money illusion? Well, it's a cognitive bias, a blind spot in our thinking. It means we tend to fixate on the number on our paycheck, the nominal value, instead of what it can actually buy in the real world. You know how it is, right? You see your account balance go up, you get that little dopamine hit, you feel richer, even if rising prices mean you can't actually afford more stuff than before. It's a classic case of our brains just getting fooled by a bigger number.
Okay, check this out. This really shows the money illusion in action. So, scenario A, you get a 2% raise. Feels pretty good, right? A raise is a raise. But inflation is at 4%. Now, scenario B, you take a 2% pay cut, but there's zero inflation. That feels awful, absolutely terrible. But here's the crazy part. Look at the bottom line. The real outcome, your actual purchasing power, has dropped by exactly 2% in both cases. Our feelings are totally disconnected from the math. And that, my friends, is the trap.
Okay, so if inflation is the big bad enemy, what's the weapon everyone tells you to use? For generations, Wall Street has had a very simple one-size-fits-all answer. Stocks. Just buy stocks. So let's dig into why that became the conventional wisdom. So the big question is, are stocks really the ultimate foolproof answer to beating inflation? Well, conventional wisdom screams yes, absolutely. And you know the logic, it seems really solid on the surface. Prices for everything go up, so companies just charge more. Their revenues go up, their profits go up, and so their stock prices should go up too, right? For decades, this has been the go-to argument. Stocks are the hedge, but is it really that simple?
And look, the long-term data seems to scream that this is true. Just look at this period, from 1915 to 1970. Stocks delivered an annual return of around 8%. That's more than double what you'd get from high-grade bonds. I mean, when you see a chart like this, the conclusion feels totally inescapable. You gotta own stocks to protect your purchasing power. Case closed. But, as we're about to see, that beautiful long-term average hides some really painful truths.
All right, this is where we have to dig a little deeper. We're going to look at when stocks can actually fail you. And this is where we need to put on our detective hats. Because just relying on those long-term averages, it's dangerous. Think about it. Nobody invests for the long-term average. We live and invest through specific economic seasons. And it turns out, during some of those seasons, especially periods of high inflation, stocks have been a truly terrible place to hide.
You know, there's this great story about the legendary banker J.P. Morgan. Some nervous investor comes up to him and asks, "Mr. Morgan, what's the stock market going to do?" And Morgan, without missing a beat, just says, "They will fluctuate." It's probably the most honest and important three-word lesson in all of finance. It's a fundamental warning that there are no guarantees and the path is never, ever a smooth, straight line up.
Yeah, the data tells a very different story than the myth. Let's look at a specific period, 1966 to 1970. The cost of living shoots up 22%, and stock prices actually fell. And believe me, this was not a fluke. If you look at all the years since 1926, when inflation was over 6%, the stock market lost money in 8 of those 14 years. That's more than half the time. The takeaway is just crystal clear. High inflation doesn't help stocks. In fact, it often hurts them, badly. The average return was a measly 2.6%.
So this brings us back to that question that just keeps nagging, right? Shouldn't profits just go up with inflation? I mean, a company's costs go up, so they just pass them on to us, the customers. Their profit margins should be safe, their earnings should keep pace. It makes perfect sense on paper. But the reality of actually running a business, well, it's a lot more complicated than that.
And this table right here, this reveals the hidden culprit. Look over this 20-year inflationary period. It's true, corporate profits more than doubled. Not bad.
But here's the kicker. Look at the corporate debt. It expanded nearly five-fold. It just exploded. Companies were borrowing staggering amounts of money just to keep the lights on and manage rising costs. And that massive debt load, it acted like a giant anchor, making sure that those higher revenues never actually translated into higher real returns for the shareholders, for people like you and me.
Okay, so if stocks aren't the magic bullet we thought they were, what do? Are we just stuck? Well, no. The good news is that the modern investor's toolkit has gotten a lot bigger. We now have access to some really fantastic, more direct tools we can use to fight back.
All right, inflation fighter number one, REITs. That stands for Real Estate Investment Trusts. The simplest way to think about them is like a mutual fund, but for properties. So these companies, they own things like apartment buildings, shopping centers, office towers, and their whole business is collecting rent. Now think about it. When inflation hits, what happens to rent? What happens to property values? They tend to go up, right? This gives REITs a really natural built-in hedge. And the best part is you can easily own a whole basket of them through a simple, low-cost mutual fund. Okay, next up we have TIPS. That stands for Treasury Inflation Protected Securities. And these are maybe the most direct inflation hedge you can possibly own. They're U.S. government bonds, so they're about as safe from default as it gets. But the real magic here is that their value, the principal, automatically goes up with the official inflation rate. Your investment is literally guaranteed not to lose purchasing power. Now, there is one really important catch you need to know. The IRS taxes that inflation adjustment every year as income. So because of that, they are a perfect fit for a tax-deferred account, like your IRA or 401k. All right, so let's pull all this together. We've identified the problem, that sneaky money illusion. We've busted the myth that stocks are the only answer. And we've added a couple of new tools to our belt. So now, let's talk about building a truly resilient portfolio, the intelligent defense.
This quote from way back in 1965 is really at the heart of the whole solution. It's not about finding one perfect asset that will always win. That doesn't exist. It's all about balancing the risks. You see, an all-bond portfolio just gets eaten alive by inflation over time. But we've seen that an all-stock portfolio can be really vulnerable, especially when inflation is high. So the real answer, the intelligent answer, is in a sensible, deliberate mix of the two, and more.
So, what does this intelligent defense strategy look like today? It's basically 4 steps. Step 1, acknowledge the risk. Just accept that inflation is a persistent, permanent threat. It's not going away. Step 2, question convention. Realize that just blindly piling into stocks is not a guaranteed solution. Step 3, diversify your tools. Bring in those modern hedges we talked about, like REITs and TIPS. And finally, step 4, and this is the big one, prepare for uncertainty. The goal is to build a portfolio that can handle multiple different futures, not just the one you think is going to happen.
And that really brings us to the final crucial question you have to ask yourself. Are you investing based on popular opinion, on what everyone else is saying, on what worked yesterday? Or are you truly preparing for an uncertain future? The answer to that question is going to define your success as an investor. Thanks for watching.
All right, let's just jump right in. I want you to picture something. It's the end of 1999. The dot-com boom is in full swing, right? The internet feels like it's changing the entire world, and stocks, well, they only seem to go one way, up. There was this incredible feeling of optimism, like we'd entered a totally new golden age for investing. But as we're about to find out, history has this funny habit of repeating itself, and usually in the most painful ways imaginable. And this quote, this just perfectly captures that mood. You've got a fund manager on national TV, and someone asks him, hey, these tech stocks, they have no profits, but their prices are going through the roof. Is this a bubble? And his answer, with total confidence, is, it's not a mania. See, the belief was that the rules of the game had changed, that the growth was so real, so revolutionary, that all the old ways of figuring out what a company was worth, they were just obsolete. This wasn't some crazy bubble, no way. It was a new reality. Or at least, that's what everybody told themselves. And it wasn't just one guy. The so-called experts were all doubling down on this. A month later, another top strategist comes out with this gem, a new world order. He's basically saying the single worst mistake you could possibly make was not buying these super expensive stocks. The message was loud and clear. Get in or get left behind. The fear of missing out was way, way bigger than the fear of overpaying. As long as the story was good, the price just didn't matter. So, what was the result of all that new world order thinking? This, a loss of over $7 trillion. Let that sink in for a second. That's trillion with a T. Between the spring of 2000 and the fall of 2002, the U.S. stock market just imploded. This wasn't just numbers on a screen, it was a total catastrophe that absolutely wiped out the retirement accounts and savings of millions of people. And it was a brutal lesson that, yes, price always matters. So that brings us to the real question, right? How on earth does this keep happening over and over again? And maybe more importantly for us, how can we avoid getting caught in the crossfire? Is there a way to get through these insane cycles without getting completely wiped out? Well, there is. And the answer, believe it or not, is found by looking at the past. Our guide on this journey is going to be a legend, maybe one of the greatest investors ever, Benjamin Graham. You see, Graham's whole philosophy, his big idea, was really simple but profound. He said that if you want to have any clue what's going on today, you absolutely have to understand what happened yesterday. He knew the stock market was just this long, repeating story of booms and busts. And by studying those cycles, we can arm ourselves with the one thing we need most, perspective. The kind of perspective that lets us act with our brains, not with our emotions. So Graham basically sliced up market history into three big chunks. First up, the early 1900s to about 1924. This was a time of, well, fairly normal cycles. Things went up, things went down, usually in a 3 to 5 year pattern. Predictable almost. But then came the second era, from 1925 to 1949. This is where things got wild. You had the Roaring '20s boom, followed by the absolute devastation of the 1929 crash, and this long, ugly recovery that made an entire generation of people just hate stocks. And that led to the third era, starting in '49, the Great Bull Market. This was a monster, a 20-year rocket ride that completely rewired how people thought about investing. And this psychological shift was something Graham found just fascinating. He called it the most remarkable turnabout in all stock market history. Think about it. In 1949, right before this epic bull market began, stocks were absolute poison. Nobody wanted them. They were seen as just pure, risky gambling. Fast forward to the late 60s, and what happened? After 2 decades of incredible returns, stocks were the only game in town. The public had gone from total despair to complete unbridled euphoria. It was a 180-degree flip in psychology. And just look at how violent these swings can be. I mean, an 86% loss after the '29 crash, that's almost everything, gone. Then you have a mind-boggling 515% gain in the boom after the war. But even then, you get these sharp, brutal reminders that gravity still exists. A 37% drop in the late 60s, that 50% haircut during the dot-com bust we just talked about. The point here is crystal clear. These big swings aren't a bug, they're a feature. This is just what the market does. Now, you might be thinking, okay, if we study all this history, does that mean we can predict what's coming next? And this is where Benjamin Graham throws a little cold water on things, with a huge dose of humility. Because even with all this data, all this history, he was incredibly wary of anyone who claimed they could forecast the future. He knew, deep down, that having solid principles was infinitely more valuable than trying to make predictions. I mean, listen to this. This is Graham in his own words, basically admitting that all his fancy attempts to time the market probably weren't as helpful as his simple, boring advice. His pedestrian counsels, as he calls them. And what was that advice? Just have a consistent, controlled, disciplined plan. See, the goal isn't to be the genius who can predict exactly when the storm is going to hit. The goal is to be the person who built a solid arc so you're ready whenever it does. He even pulled out Aristotle to back this up, which is pretty cool, right? But the point is serious. He's saying, look, investing isn't physics. It's not math. You can't demand perfect, precise answers because the subject itself is messy and human. It's all about probabilities and psychology. So an educated mind in this field isn't looking for certainty because that's a fool's errand. They're looking for a smart way to manage uncertainty. Okay, so this brings us to what might be Graham's single most important lesson: what a stock is worth. If we accept that we can't predict the crazy moods of the market, what's left? What can we actually control? And the answer is simple. We can control the price we pay. The real secret to success isn't picking the hottest stock. It's about not being a sucker and paying a sensible price for whatever you buy. And this right here, this is the bedrock principle. It's everything. The value you get from any investment is always, always tied to the price you paid to get it. Think about it. A company can only earn so much money in the future. It's a finite number. So the price you should be willing to pay for that company has to be finite too. This idea right here is the ultimate cure for the kind of speculative fever that causes those bubbles in the first place. Okay, let's make this real. A tale of two markets. Back in 1949, when stocks were deeply unpopular, you could get a 7% return just from dividends. Meanwhile, a super safe high-grade bond was only paying you 2.6%. It was a no-brainer. Stocks were an incredible bargain. Now, let's fast forward to 1972. The whole world has flipped upside down. Stock dividends are now down to 2.9%, while those same safe bonds are paying 7.2%. This was a giant flashing red light, screaming that investors had lost their minds and were paying way too much for stocks. So how do we measure this? Well, a really useful tool is the PE ratio, or price-to-earnings ratio. All it is the price you're paying for $1 of a company's profits. It's basically the stock's price tag. Now check this out. In 1949, when stocks were dirt cheap, the PE was just 6.3. By 1961, during the big boom, it shot all the way up to 22.9. That means people were willing to pay almost 4 times more for the exact same amount of a company's earnings. That's a huge shift in sentiment. Here's a great way to think about it. Michael Jordan, probably the greatest basketball player of all time, right? The Bulls paying him millions of dollars a year was an absolute steal for them. But what if they had to pay him $300 million a year, or 3 times billion? Would that have been a good deal? No way. It's the exact same logic with stocks. You can find the most amazing company in the world, but if you overpay for it, it can still be a terrible investment.
So let's put this all together. We know we can't predict the future, but we also know that the price we pay is critical. So how do we square that circle? How can we form some kind of reasonable expectation about the future without pretending we have a crystal ball? Well, Graham gave us a really simple but really powerful framework to do just that.
He said your return on stocks really only comes from 3 things. First, you've got real growth. This is just the companies actually doing better business, growing their earnings. Historically, that's been pretty steady, maybe 1.5 to 2% a year. Second, you have inflationary growth, basically the general rise in prices. But then there's the third piece, and this is the wild card, speculative growth. This is all about emotion. It's just the change in what other people are willing to pay for those earnings, that PE ratio. The first 2 are kind of predictable. The third one, pure fear and greed, totally unpredictable.
So let's try to build a reasonable expectation using this model. You start with that real business growth, call it 1.5%. Then you add a decent guess for inflation, say 2.5%. And finally, you throw in what companies are actually paying you right now in dividends, let's say another 2%. You add all that up and you get a pretty sensible baseline. Now, those insane 20 or 30% returns people saw in the late 90s, well, that came from that third bucket, pure speculation, going completely off the rails. And that kind of thing just can't last.
So where does that leave us? Right here. A sober, reasonable long-term expectation for what the stock market might deliver is something in the ballpark of 6% a year. Now, just for a second, compare that to the dot-com peak, when the average investor thought they were going to make over 18% a year every year. That huge gap between sober reality and wild fantasy, that is the danger zone. That's where people get hurt.
Okay, final section, the intelligent investor's path. After all this history and theory, what do we actually do? How are we supposed to act when we're staring down an uncertain future, knowing the market can swing from total madness to complete misery? This is where all of Graham's wisdom gets really practical, really fast.
When Graham felt the market was getting frothy and dangerous, like he did in the late 60s, his rules were incredibly simple and all about playing defense. Rule number 1, don't borrow money to buy stocks, ever. Using debt is how a bad situation becomes a complete catastrophe. Rule 2, don't start putting more money into stocks just because prices are going up. And Rule 3, keep your portfolio balanced. He said you should never have more than half your money in stocks when things look overheated. You see the theme here? It's not about getting rich quick. It's about ensuring you survive to invest another day.
And I think we should end on this quote because it just perfectly sums up the entire mindset of an intelligent investor. True success in the market isn't about making wild predictions or taking crazy risks. It's built on humility, it's built on discipline, and most of all, it's built on having realistic expectations. You know, the minute you stop expecting the market to make you a millionaire overnight, you're free. You're free from the emotional roller coaster of fear and greed that trips everyone else up. You can handle the bad times, and as the quote says, you'll be in the perfect position to enjoy the good times when they finally arrive.
Welcome back to The Explainer. Today, we're cracking open Benjamin Graham's legendary book, The Intelligent Investor. We're jumping straight into Chapter 4, which is all about building a portfolio for what he calls the defensive investor. Now, this is for you if you want to build real wealth, but, without making it your full-time job to stare at stock charts all day.
All right, so let's get right into it by tackling a piece of advice you've probably heard a million times. It's almost a cliche at this point. The younger you are, the more risk you should take on. But is that really the whole story? Is it really that simple?
You know the rule. Conventional wisdom gives you this neat little formula. Take 100, subtract your age, and boom, that's how much you should have in stocks. If you're 30, you're 70% in stocks. If you're 60, you're 40%. It's clean, it's easy, and according to the master, Benjamin Graham, it's just plain wrong. He says the real deciding factor isn't your birthday, it's you, your personality, your temperament, and how much actual intelligent work you're willing to put in.
So here's our game plan for walking through Graham's logic. First, we're going to bust that myth about age and risk. Then we'll help you figure out which kind of investor you really are. From there, we get into the practical stuff, his super simple 50-50 rule, the magic of rebalancing, and how to pick the right bonds. And we'll finish up by revealing what Graham believed is the single biggest risk to your money.
Okay, first up, investing beyond your age. This is really the foundation of Graham's entire philosophy. It's a total shift in how we think about where returns actually come from. It's not about how much risk you can handle, it's about something totally different.
So here's the absolute key takeaway. Graham says most of us have it completely backwards. We think bigger returns come from taking bigger risks. He says no way. Higher returns should be the reward for putting in more intelligent work. The minimum return, that's for the passive investor who just wants safety and, maybe more importantly, freedom from worry. The maximum return is for the person who's willing to put in the time and develop real skill. It's about work, not just guts. And that leads us to what is honestly probably the single most important question you have to ask yourself before you put a single penny into the market. Because if you get this one wrong, you're pretty much setting yourself up for a lot of pain. So, are you an active or a passive investor? Now, Graham is crystal clear on this. He says there are two and only two sensible ways to be an intelligent investor. Path number one is the active or enterprising investor. This is the person who's constantly researching, digging into companies, and actively managing their portfolio. Path number two is the passive or defensive one. This person builds a dead simple, permanent portfolio that basically runs itself. And Graham insists both paths are equally intelligent. The trick is you have to know which one fits you.
And here's where we really need to be honest with ourselves. The active path isn't a hobby, it's a grind. It's intellectually taxing, and it takes up a ton of time and energy. The defensive path, on the other hand, is emotionally demanding. It takes a will of iron to just stick to your plan and ignore all the noise from the market. Choosing the wrong path, like a chill, passive person trying to be a day trader, is one of the quickest ways to go broke.
So before you even start thinking about stocks and bonds, you've got to think about your actual life. These questions force you to get real. Are you the only one bringing in a paycheck? Are there huge college bills coming down the pike? Could your whole industry get disrupted? Your personal financial situation is the true foundation of your investment plan, not what the S&P 500 did this morning.
Okay, now that we've got a handle on what kind of investor we are, let's look at how Graham turns this whole philosophy into a really simple but really powerful rule for your portfolio. This is where the theory hits the road.
Graham starts by setting up some guardrails. His first rule is that a defensive investor should never, ever have less than 25% of their money in stocks. Why? Because this ensures you at least get to participate in the long-term growth of the economy. It's your ticket to the game.
And then, on the flip side, he says you should never have more than 75% in stocks. That other 25% in high-quality bonds, that's your anchor. That's your safety cushion. That's what gives you the backbone to not panic and sell everything when the market inevitably takes a nosedive. So if you have these two boundaries, a floor of 25% and a ceiling of 75%, what's the logical starting point? Well, it's right in the middle, a simple 50-50 split between stocks and bonds. For the average defensive investor, this is the default. It's balanced, it's simple, and it's easy to follow.
And this is where the real genius of the rule kicks in. It's got nothing to do with predicting what the market's going to do next. Its main job is to control you. It's a behavioral tool. It acts like a governor on an engine, stopping you from getting swept up in the hype of a bull market and piling into stocks right when they're the most expensive and dangerous. So that's great in theory, but how do you actually keep that 50-50 balance when the market is flying all over the place? The answer is a simple automatic process that takes all the guesswork and emotion out of it. It's called rebalancing.
Let's just walk through an example. You start at 50-50. Stocks have a great year, and suddenly that part of your portfolio is now worth 55%. The rule says, nope, we're going back to 50-50. So you have to sell that extra 5% of stocks and use the money to buy bonds.
you're automatically forced to sell high. And think about the other way. If stocks crash and drop to 45%, the rule forces you to sell some bonds and buy stocks. You're automatically buying low. It's a system for being rational when every bone in your body is screaming at you to do the opposite.
So really, the heart of this whole thing is to take you, with all your fears and your greed and your biases, out of the day-to-day decision-making. You're not trying to be a psychic. You're not trying to time the market. You are just executing a plan. A simple, disciplined plan.
Okay, we've talked a lot about the stock side of the equation, but what about that other 50%? You know, the anchor that makes this whole strategy work? Let's take a look at the bond component. The world is a lot more complicated than it was in Graham's day, but his basic principles are still spot on.
For a lot of people today, the number of choices can feel just, well, paralyzing. You've got U.S. Treasuries, municipal bonds, corporate bonds, mortgage-backed securities. I mean, where do you even start? Let's try and simplify it.
So here's a quick breakdown. U.S. Treasuries are about as safe as it gets from default risk, but their price can go down if interest rates go up. Corporate bonds will pay you a higher yield, but you're taking on the risk that the company could go bust. And municipal bonds are awesome for their tax-free income, especially for high earners. But you know, for most defensive investors, the simplest and smartest move is probably just to own a single, low-cost bond fund that holds a little bit of everything for you.
All right, let's bring it all home. We're going to wrap this up by focusing on the single biggest threat to your long-term wealth. It's the one thing that trips up more investors than anything else combined.
Look, I know it's tempting, especially in a bull market, to just ignore Graham's 75% limit and go all in on stocks. But before you even think about it, you have to pass this test. And I mean, be brutally honest with yourself. Do you really have a full year of living expenses just sitting in cash? During the last market crash, did you actually buy more stocks or did you sell? Unless you can look at this list and say yes to every single one of these points, you have absolutely no business putting 100% of your money in the stock market.
And this, right here, is the ultimate lesson from Benjamin Graham. We spend all this time worrying about the economy, about earnings, about what the Fed is going to do. But the most important analysis we'll ever do is looking in the mirror. Your own behavior, your urge to panic when things get scary, your greed when things get euphoric, that is a far, far bigger risk to your wealth than any market crash will ever be.
So I'll leave you with this question. Now that you know the rules of the game, what's the real challenge? Is it figuring out the market, or is it figuring out yourself? Because mastering the technical stuff, that's the easy part. The real lifelong job of an intelligent investor is mastering your own emotions. And that is a challenge that's absolutely worth taking on.
Welcome to The Explainer. Today, we are opening up the playbook of one of the all-time greats, Benjamin Graham. We're going to break down a timeless strategy for anyone who wants to invest wisely, without losing sleep every time the market has a hiccup. This is about building a strategy that works, plain and simple.
All right, let's just dive right in. And to do that, we have to start by acknowledging something real, that feeling of fear. Let's be honest, the market can feel like total chaos, like a roller coaster specifically designed to make you panic. So, where do you even start?
In this question, this is probably the most logical question in the world, right? Especially if you've been through a big crash and felt that pain firsthand. I mean, when you've just seen your portfolio get absolutely hammered, down 30, 40, even 50%, the very idea of buying more stocks, well, it sounds kind of crazy.
I love this old proverb because it just perfectly captures how we think as investors. That memory of getting burned, of that hot milk market crash, it sticks with you, and it makes you incredibly cautious about everything that comes after, even things that are perfectly safe or have cooled down significantly.
But here's the beautiful paradox of it all. The crash itself, the very thing that scares us, often makes the market less risky. And why is that? It's simple. Prices are way lower. All that speculative hype and froth gets completely wiped out. The hot milk from the market peak cools down into room temperature yogurt after the fall. The real danger wasn't in the companies. It was in the ridiculously high prices people were paying for them.
So how do we actually navigate this? How do we invest with some confidence instead of being driven by fear? Well, for that, we turn to the master himself, Benjamin Graham, and his incredibly powerful yet simple set of rules for what he called the defensive investor. First off, let's be really clear about what defensive means here. This isn't about being scared or stuffing your cash under the mattress. Not at all. It's about being smart, it's about being disciplined, and importantly, it's about not having to spend every waking hour researching stocks.
The #1 goal is just to avoid those catastrophic mistakes that can completely knock you out of the game. So, Graham lays out these 4 brilliant rules. First, diversification. You know the old saying, don't put all your eggs in one basket. It's a cliche because it's true. Between 10 and 30 stocks is his sweet spot. Second, stick to quality. We're talking about large, well-known companies with solid finances, the boring stalwarts. Third, and this is a great one, demand a long history of paying dividends. It's a fantastic sign of a stable, healthy business. And finally, #4, do not overpay. You have to set a limit for yourself based on what the company actually earns and stick to it. You put these 4 together and you have a rock-solid foundation.
Now, if you look closely at that last rule, don't overpay, you might start to realize that it pretty much kicks a whole category of very popular, very flashy stocks right out of the running. And trust me, that's completely on purpose.
And what are those stocks? Well, they're the growth stocks. You know the ones. They're the darlings of the financial news, the companies that promise the moon based on the idea that their incredible growth is just going to keep going and going and going. They're exciting, for sure, but they come with a massive hidden risk. The problem is that all those hopes and dreams for the future get priced into the stock today. That introduces a huge amount of speculation. And when expectations get even a little bit out of line with reality, look out below. Even a legendary company like IBM, an absolute titan of its industry, has had its stock price literally cut in half multiple times. And this case study with Texas Instruments is just a perfect illustration of what Graham called the double discomfiture, a double whammy basically. On the way up, as profits grew, the stock price grew 5 times faster. Insane. But when the company's earnings just stumbled a bit, the stock didn't just stumble, it completely collapsed by 4/5. Investors got hit twice. Once on the actual business results, and again on that speculative bubble popping.
This brings us to another really common trap. It's a more modern idea that sounds fantastic on the surface, but man, it can be just as dangerous if you don't understand the whole picture.
The great fund manager Peter Lynch made this phrase famous: buy what you know. And the idea is powerful. He argued that your everyday knowledge, as a consumer or a professional, can give you an edge. You might spot a great company before the so-called experts on Wall Street do.
But here's the thing. Everybody loved the first part of that advice and completely ignored the second. Lynch was crystal clear. Finding a cool company you like is only step 1. Step 2, the part everyone seems to forget, is you still have to do the research. You have to look at the financials, check the balance sheet, and, just like Graham said, make sure the stock isn't overpriced.
When you skip that second step, you fall into this dangerous psychological trap called home bias. Hey, I love my Starbucks coffee, but that doesn't automatically make the stock a good buy, right? And we saw this tragically with employees at places like Enron. They thought they knew the company, so they loaded up their retirement accounts with its stock, only to lose everything. Familiarity feels like knowledge, but it often just breeds a false sense of security.
Okay, so if picking individual stocks, even companies you think you know like the back of your hand, is so full of traps, what's the answer? What is the modern defensive investor's ultimate weapon? Well, the answer is to find a way to take yourself and all your emotions out of the equation.
And the technique to do that is profoundly simple, yet unbelievably powerful. It's called dollar cost averaging. All it means is that you invest a fixed amount of money on a regular schedule, say a couple $100 on the first of every month. No matter what the stock market is doing, up, down, sideways, you just keep buying. It's investing on autopilot.
And the results, they are just stunning. Seriously, look at this. Let's take the absolute worst time in history to invest, right at the peak before the Great Depression. If you put 12 grand in all at once, 10 years later, you'd have about $7,000 left. A disaster. But if you had just put in $100 a month every single month through that entire catastrophe, you would have come out the other side with over $15,000. Your disciplined buying turned the worst market ever into a profitable venture. It's incredible.
Now let's look at something a bit more recent, the dot-com bust from 2000 to 2002. The market got absolutely crushed, falling more than 41%, a really painful time. But if you were on autopilot, just dollar cost averaging your way through it, your loss was significantly smaller, around 30%. Your steady buying when everyone else was panicking cushioned the blow and set you up beautifully for the recovery that followed.
And that brings us to the final and maybe the most important piece of this whole puzzle. It's not a rule. It's not a technique. It's a fundamental shift in how you think about investing. It's a mindset.
When you fully commit to an autopilot strategy like dollar cost averaging, especially into broad index funds, you earn the right to say what might be the 3 most liberating and powerful words in all of finance. When someone asks you what you think the market is going to do next, you can look them in the eye and say, "I don't know, and I don't care." Think about that. Are stocks going to beat bonds this year? I don't know, and I don't care. I own both. Are international markets going to outperform the US? Who knows? But I own them too. The second you stop trying to predict the future, which is impossible anyway, you take away all the market's power to mess with your head and cause you to make emotional mistakes.
So, at the end of the day, it really boils down to this, doesn't it? We spend all this time and energy trying to find the secret formula to outsmart the market. But what if that's the wrong game entirely? What if true long-term success isn't about predicting the future at all, but is actually about having a system in place to control yourself?
All right, today we're diving into a really powerful and, honestly, a kind of counterintuitive idea from the master himself, Benjamin Graham. We're talking about a way to invest that isn't about chasing the next big thing. It's about learning how to avoid the big mistakes that can absolutely wreck your portfolio. So let's just stop and think about this for a second, because it's a huge idea. What Graham's really saying is that if you're actively trying to do better than average, your biggest wins might not come from the stocks you pick. They'll come from the bad ideas you don't fall for. It's basically a guide to what you should say no to. Okay, here's what we've got on tap. We're going to break down who this enterprising investor is, then walk through 4 of the biggest traps Graham warned us about, and we'll wrap it all up with this core concept of how you can win simply by not losing. So first things first, who exactly are we talking about here? Who is this enterprising investor? And, it's super important we define this because this is the exact person who's most likely to get sucked in by all the hype and fall right into the traps we're about to cover. So this is you if you're not happy just riding the market. You want to find an edge, you want to get better returns, and that's a great goal. But, and this is the big but, that very ambition, that drive to find something special, makes you the perfect target for deals that promise the world but are actually hiding some serious risk. All right, let's get into our first big warning. This is a trap that gets people time and time again. It's the chase for those really juicy, high-yield bonds, what today we call junk bonds. They look so tempting on the surface. And this right here is Graham's whole argument in a nutshell, and it is just brutally logical. Think about it. Does it make any sense to risk losing, say, 50, 60, maybe even 100% of your original investment just for a shot at an extra 1 or 2% a year? No way. The math is completely upside down. It's a sucker's bet. And if you want to see this trap play out in the real world, boy, do we have a story for you. Let's talk about WorldCom. Back in 2001, at the height of the telecom bubble, they issued a record-breaking amount of bonds, a mountain of debt that the public just couldn't wait to buy. And why were people so eager? Simple. They were absolutely hypnotized by the yield. We're talking yields as high as 8.3%. And it wasn't just small investors. Even big, supposedly sophisticated pension funds later admitted, yeah, we got lured in by that big, fat payout. Now, just look at this disconnect. It's staggering. On one side, you have this incredibly attractive 8.3% yield. It's like a bright, shiny lure. But on the other side was a reality that was just sitting there in their public filings for anyone to see. The company was already losing billions and couldn't even afford the interest payments it already had. The flashing red lights were everywhere. And here's the punchline. Just over a year later, WorldCom was bankrupt. That beautiful 8.3% yield, gone. Vanished. And the investors who chased it, they lost about 80 cents on every dollar they put in. A complete and total disaster that proves Graham's point perfectly. Okay, next up, Graham warns us about another place where high yields can fool you, foreign government bonds. Now, the bait is exactly the same, a higher interest rate than you can get at home. But the risks are on a whole different level. And this is the absolute crucial difference. If a company in your own country goes bust, you've got bankruptcy courts, you've got a legal process, you might get something back. But if a foreign government just decides, we're not paying, what can you do? Pretty much nothing. You have no real power, no recourse. You're completely at their mercy. Just look at the crazy ride investors took on this one Czechoslovakian bond.
I mean, it's a roller coaster. Up to 112, crashes to 67, recovers. Then World War II hits and it plummets to just 6. Then it recovers again after the war before crashing again. This is pure chaos, driven by huge geopolitical events. How can an ordinary person possibly predict any of this? You can't.
All right, let's move on to one of the most tempting traps of all, especially when the market is hot. We're talking about new stock issues, specifically IPOs, or initial public offerings. This is the ultimate siren song for the ambitious investor.
You know the feeling. Everyone's buzzing, trying to get in on the ground floor of the next big thing. But Graham hits us with 2 cold, hard truths. First, remember that IPOs are sold to you. They're not something you go out and buy. A massive Wall Street sales machine is pushing them. And second, think about it. When does a company want to sell its stock? When it can get the absolute highest price possible, which, by definition, is usually the worst time for you to be the buyer.
In fact, some people have come up with a few, shall we say, more realistic definitions for what IPO stands for. It's a bit of fun, but there's a serious point here. You have to approach these things with a ton of skepticism. And if you need a perfect example of IPO mania, look no further than VA Linux, right from the heart of the dot-com bubble. I mean, come on, look at this chart. It went public at $30 a share, and on its very first day of trading, it hit a high of $320. The hype was off the charts. The end of the story? 3 years later, the stock was trading for $1.19. So what happened? Well, the hype had absolutely nothing to do with the business itself. This company was a financial dumpster fire. It was losing almost 70 cents for every single dollar of sales it made. And yet, for a brief, shining moment, the market said this business was worth almost $13 billion. It was just complete and utter madness. Okay, our final trap isn't about a specific thing you might buy, it's about how you invest. It's the danger of trading too much. Graham was always suspicious of hyperactivity, and, well, all the modern data shows his instincts were dead right. And I love this analogy of sandpaper, because that's exactly what it is. Every time you buy or sell, there are these little costs. You've got broker commissions, you have the bid-ask spread, that's the market maker's little slice, and then you have taxes, which are way higher on short-term trades. Each one is just a little swipe of sandpaper, slowly but surely rubbing away your potential profits. And this isn't just a theory. Look at this famous study. They looked at the actual accounts of thousands of real investors. The results are mind-blowing. The people who traded the least, the ones who were most patient, they actually managed to beat the market, just by a tiny bit. But the most active traders, the people who were always buying and selling, they got demolished. They underperformed the market by 6.5% per year. All that effort was just making them poorer. So we've walked through all these landmines, junk bonds, risky foreign debt, overhyped IPOs, and the constant churn of trading. So what's the big lesson here? What's the main takeaway for that enterprising investor who's trying so hard to get an edge? This quote from the legendary boxing trainer Angelo Dundee just says it all, doesn't it? In a long, tough fight, it's not always about landing that one perfect haymaker. It's about conserving your energy. It's about not taking wild swings that leave you open. It's about dodging the big punches that can knock you out of the fight for good. And investing is exactly the same game. And really, that's what it all boils down to. In a world, in a market that is screaming at you 24/7 to do something, buy this, sell that, maybe your single greatest advantage is the discipline to just stand still. By just saying no to the high-yield traps, no to the IPO frenzy, and no to the frantic churn of trading, you protect your money, you protect your mind, and you save them both for the real, genuine opportunities. And that, my friends, is how you win by not lose it.
You know, let's be real for a second. Most folks would be pretty happy just getting average market returns. And hey, there's nothing wrong with that. But what if average just doesn't cut it for you? What if you're actually willing to roll up your sleeves and work for something better? Well, if that's you, you might just be what the granddaddy of value investing, Benjamin Graham, called an enterprising investor. So today we're going to crack open his playbook. This is the strategy for anyone who wants to use their brain to get better than average results. Let's dive in.
So here's our game plan. First up, we're going to define what this whole enterprising investor thing is really all about. Then, and this is crucial, we'll look at the 2 biggest traps that always seem to trip up ambitious investors. After that, we'll get into the good stuff, Graham's 3 core strategies for actually beating the market, including how to hunt for serious bargains. And we'll wrap it all up with the most important piece of the puzzle, learning to treat your investing like a business.
All right, so the enterprising investor's quest. What does that even mean? Well, really, it's a mindset. It's for the person who isn't content to just float along wherever the market goes. See, they're not just hoping for good returns, they are actively, and I mean actively, working to create them. This is the opposite of passive investing. It's a hands-on, deliberate pursuit of something more.
And just listen to the words Graham uses here. Devotes significant attention and effort. Right away, that tells you this has nothing to do with luck or getting some hot stock tip from your buddy. No, this is a real commitment. It's a disciplined, almost professional approach to the market. It's a path that demands serious work, but as we're about to see, the potential rewards are absolutely worth it.
Okay, but before we learn how to win the game, Graham is insistent that we first have to understand how not to lose it. Because the road to outperformance is just littered with traps, and a couple of them are especially dangerous for people with ambition. So let's break these down, because believe me, just knowing what to watch out for is half the battle.
So trap number 1. Oh, it's the siren song of market timing. You know, the dream of perfectly buying at the absolute bottom and selling at the absolute top. It sounds amazing, right? But it's practically impossible. And this quote is just the perfect, painful proof. The man who said this, Alan Greenspan, the year 1973. This was right before one of the most vicious market crashes since the Great Depression. So if the guy who would go on to be the chairman of the Fed got it that spectacularly wrong, what chance do the rest of us really have?
Now, the second trap, this one feels so right, which is exactly what makes it so dangerous. It's the temptation to chase those high-flying, fast-growing companies. I mean, of course you want to own the next big thing. Who wouldn't? The problem is, so does everybody else. And all that hype drives the price up and up and up into the stratosphere. And before you know it, you're paying a ridiculous price for promises of future growth, which, as Graham warns, is a classic recipe for disaster.
And this quote right here from Graham, this is the absolute heart of his philosophy. A great company is not the same thing as a great investment. It's such a simple idea, but it's incredibly profound. You could have picked the most amazing, innovative company in the world and still have lost a ton of money. Let me show you the proof.
Do you remember these names from the late 90s? General Electric, Home Depot, Sun Microsystems. I mean, these companies were the titans, the absolute darlings of the stock market. And back in early 2000, investors were paying insane prices for them, a price-to-earnings ratio of nearly 50 for GE. And what was the result? Well, over the next 3 years, anyone who bought at the peak got absolutely demolished. A 47% loss on GE, a mind-boggling 93% loss on Sun. This is just a perfect, painful lesson in what Graham was warning us about. A fantastic business bought at a terrible price is a terrible investment, period.
This chart really just says it all, doesn't it? The higher that bar for the price you paid, the lower, and sometimes negative, the bar for the return you actually walked away with. It's almost like a law of financial physics. You're paying today for growth that you hope will happen tomorrow. But the thing is, that kind of explosive growth is incredibly hard to keep up. So the higher the expectation that's already baked into the stock price, the more likely you are to be disappointed.
Okay, so we've seen the traps, we know what to avoid, so what in the world should we be doing? Well, this is where Graham really starts to shine. He didn't just point out the dangers, he gave us a clear, actionable blueprint for the enterprising investor to follow.
He laid out 3 specific areas to operate in. First, buying big, well-established companies when they're temporarily unpopular. Second, actively purchasing what he called bargain issues, which are basically stocks selling for way less than they're actually worth. And third, investing in special situations, things like reorganizations or takeovers. Now that third one's a bit more advanced, so for our purposes today, we're going to focus on the first 2, because they're the most practical for most of us.
The logic behind this first strategy is just, it's beautiful in its simplicity. See, the market can be really emotional. A great company hits a little rough patch, a bad earnings quarter, some negative press, and the market totally freaks out, selling off the stock like the company's about to go under. But for a rational, enterprising investor, that panic doesn't spell danger, it spells opportunity.
And look, this isn't just some nice little theory. This is backed up by decades of cold, hard data. A study tracked this exact strategy all the way from the 1930s to the late 60s. Every year, they took the 10 cheapest stocks in the Dow, those are the unpopular ones, and compared them against the 10 most popular stocks. And just look at these results. Time and time again, the boring, cheap, unpopular stocks consistently wallop the glamorous ones and the overall market average too.
So what does that outperformance look like in real money? Well, let's say you started with 10 grand back in 1936. If you just chased the 10 most popular stocks, by 1962 you'd have about $25,000. Not too shabby. But if you had simply bought the 10 cheapest, most unpopular stocks each year, you'd have ended up with almost $67,000. That, right there, is the staggering power of buying quality when it's on sale. So buying unpopular large companies is one thing. But Graham's second strategy? This takes it to a whole new level. We're talking about actively hunting for true bargain issues. This isn't just about finding what's out of favor, it's about finding provable, deep undervaluation. This is where you really have to put on your analyst hat.
Now, Graham was very specific here. A stock isn't a bargain just because it's down a little bit. Nope. To qualify as a true bargain, your own analysis has to show you that the business is worth at least 50% more than what the stock market is selling it for. This creates what he famously called a margin of safety. It's a cushion, a buffer, that protects you if you're wrong or if you just get unlucky.
So how on earth do you find a bargain like that? Well, the clearest, most extreme example Graham gave is what he called a net-net. Now, I want you to let this sink in. This is a company whose stock is trading for less than the value of its current assets minus all of its liabilities. I mean, think about that. You are literally buying the cash, the inventory, and the receivables at a discount. And you're essentially getting the entire productive business, the factories, the brand, the equipment, for free.
And the crazy part is the math is surprisingly simple. You just have to look at a company's balance sheet. Step 1, find the current assets. Step 2, subtract every single liability the company has, long-term debt, everything. That gives you the net working capital. And step 3, compare that number to the company's total price on the stock market. If the working capital is higher, you might just have found yourself a net-net.
But the big question is, does this strategy actually work? Well, Graham put it to the test. He studied a group of 85 of these net-net stocks back in 1957. The results were just incredible. As a group, the portfolio was up 75% in 2 years, which crushed the market. But for me, the most amazing part is the safety. Just look at this. 92% of them made money. And get this, none of them had a significant loss. That is your margin of safety in action. When you buy a diversified basket of assets for 50 cents on the dollar, it's pretty darn hard to lose.
And this brings us to what I think is the most important point of this entire discussion. All of these strategies, all these techniques, they aren't just a random collection of tricks. They are the result of a complete and total shift in mindset. It's about stopping being a speculator and starting to think like a true business owner.
And Graham is pretty blunt about this. He says, there is no middle ground. You're either a defensive investor, content with average returns from a portfolio you don't mess with, or you are an enterprising investor who treats this whole thing exactly like you would a business. There is no in-between. Trying to be, as he put it, half a businessman is just a recipe for failure. And this is such a critical distinction to grasp. The person who owns the entire company, they can afford to pay a fair price because they're in control. They can fire the CEO, sell off assets, change the whole strategy. But as an outside investor, a minority shareholder, you can't do any of that. Your only real power, your only true protection is the price you pay to get in the door. That discount, that bargain, that is your compensation for having zero control.
So I guess the final question Graham leaves us with is this one. Are you treating your portfolio like a business, or are you treating it like a lottery ticket? Are you buying pieces of actual companies based on real analysis and proven value, or are you just buying ticker symbols and crossing your fingers? His wisdom really challenges us to replace emotion with intelligence and to replace speculation with discipline. And in the end, that's the difference between gambling and investing. The choice is yours.
All right, let's talk about it. We're going to tackle one of the absolute toughest parts of investing, that emotional roller coaster of a fluctuating market. You know what I'm talking about, right? That pit in your stomach when you watch your portfolio drop, or that little rush of greed when things are just soaring. It's a completely human experience.
So take a look at a chart like this. I mean, really look at it. With all those sharp peaks and plunging valleys, what's your gut reaction? A little flicker of anxiety? A knot in your stomach? Well, if you feel that, you are perfectly normal. These wild swings can be genuinely unsettling. It's like they're perfectly designed to trigger our fight or flight response. But what if we could reframe this whole picture? What if this chaos wasn't something to fear, but actually something to understand? Here it is. This is the crucial mindset shift, the one idea that really separates the amateurs from the intelligent investors. See, you're not supposed to be a fortune teller. Trying to predict every market swing, that's a fool's errand. The real goal is to profit from those swings. The market's volatility isn't a threat. It's actually an opportunity in disguise, just waiting for those with the right perspective to come along. Now, to understand how to grab that opportunity, we first have to understand ourselves. Our reaction to the market isn't just about the money. It's way deeper than that. It's rooted in our own psychology. It's all driven by some very powerful and, it turns out, very predictable forces inside our own heads. So, it all starts with this powerful concept called loss aversion. Some incredible work by the psychologists Daniel Kahneman and Amos Tversky revealed something fascinating about how our brains are wired. We absolutely hate losing. The emotional pain of losing, say, $1,000, is more than twice as intense as the pleasure of gaining that same amount. It's this deep, primal fear that can trick us into panic selling at the absolute worst moment, locking in our losses just based on pure emotion.
So the big question is, how do we get a handle on these powerful emotions? How do we build a defense against our own worst instincts? Well, thankfully, the legendary investor Benjamin Graham gave us the perfect mental tool for the job. It's a metaphor, a story about a very peculiar business partner he called Mr. Market.
Okay, so imagine this. You own a piece of a private business, and every single day, without fail, your partner, this guy named Mr. Market, he shows up at your door, and he shouts a price at which he's willing to either buy your shares from you or sell you his. Every single day, a new price, a new offer.
But here's the catch. Mr. Market is, well, he's manic-depressive. Some days, he's Dr. Jekyll. He's euphoric, he sees only a perfect future, and he's offering you ridiculously high prices for your shares. But on other days, he's Mr. Hyde, totally gripped by this dark rage, seeing only doom and gloom, and trying to dump his shares on you for pennies on the dollar. The critical thing you have to realize is that this guy is a lunatic, and his price reflects his mood, not the actual value of the business.
And believe me, this isn't just a theory. This happens constantly in the real world. Just look at the saga of Inktomi during the dot-com bubble. In March of 2000, Mr. Market, in his manic phase, valued this profitless software company at an insane $25 billion. Okay, now fast forward just 2.5 years, and in a depressive fit, he claims that the very same company, which, by the way, now had more revenue, was worth a measly $40 million. Then just months after that, Yahoo swoops in and buys it for a price almost 7 times higher. Mr. Market was completely wrong on the way up, and he was utterly wrong on the way down.
So, if Mr. Market is so predictably irrational, why do so many of us fall into the trap of trying to guess his next move? It's like a siren song for investors, this idea of timing the market. But it's a game you are almost guaranteed to lose over the long run.
Essentially, you have a choice between 2 different games. The first is timing, where you try to read Mr. Market's mind and predict his wild emotional swings. The second, and much more rational game, is pricing. This is where you ignore his mood swings completely. Instead, you focus on the actual underlying value of the business itself. You calculate what it's truly worth, and you only buy when Mr. Market, in one of his funks, offers you a true bargain.
You know, Benjamin Graham put it bluntly, and it's a truth that can be hard to swallow. When you try to time the market, you're not just betting on what will happen next, you're betting that you are smarter or faster or have better information than the millions of other professionals and individuals who are all trying to do the exact same thing, many of them with way more resources than you. It's just a setup for failure.
And history proves this point again and again. The famous Dow theory for timing the market? It worked beautifully for a while, right up until everyone started using it. The moment a timing formula gets popular, the market absorbs that information, it adapts, and poof, its predictive power just vanishes. The easy money never, ever lasts.
Okay, but this is where it gets really interesting. Because while you can't outpredict the professionals, as an individual investor, you have one massive, undeniable advantage over all the Wall Street pros who are often forced to play that losing timing game whether they want to or not.
And here it is. This is your superpower. You are under absolutely no obligation to trade with this lunatic just because he shows up at your door. See, professional fund managers, they often have to buy or sell because of client redemptions or fund rules. You don't. You can simply ignore him. You have the power to just say no.
Think about what this freedom really means. You can completely disregard the daily noise of the market price. You can patiently wait for months or even years and act on his offers only when it is overwhelmingly in your interest. You can never be forced to sell your shares into a panic. In short, you can literally transform his emotional foolishness into your financial opportunity.
So, once you realize you have this power, how do you actually use it effectively? Well, it starts by making a fundamental shift in your focus, away from the things you can't possibly control, like Mr. Market's mood, and onto the handful of crucial factors you absolutely can.
You can directly control your brokerage costs by simply not trading that often. You can control your ownership costs by choosing low-fee funds. You can control your expectations by being realistic about future returns. You can control your risk through proper diversification. But the single most important factor, the one that trumps all the others, is your own behavior.
This is the ultimate behavioral shift, the reframing we talked about right at the beginning. When Mr. Market is having a full-blown panic attack and is slashing prices on everything, that is not a disaster, it is a fire sale. Imagine your favorite store announces everything is 50% off. You wouldn't run away screaming, you'd rush in to buy. A market crash is the exact same thing, offering you the chance to buy great businesses at bargain basement prices.
And that brings us to our final and maybe the most profound identity shift. To truly succeed and harness the power we've been talking about, you have to stop thinking like a stock trader who just rents stocks and start thinking like a business owner who owns a piece of an actual real-world company.
The story of the A&P grocery chain illustrates this perfectly. Back in 1938, during the Great Depression, Mr. Market valued the entire company for less than the cash it had in the bank. I mean, just think about that. He was literally offering to give you the business plus a pile of cash for free. Of course, a rational business owner would snap that up, and a year later, the stock more than tripled. Then, by 1961, his mania returned, and he priced the same steady company for a brilliant future growth that was pure fantasy. His prices had absolutely no connection to business reality.
So ultimately, you have to choose which one you want to be. The speculator lives and dies by Mr. Market's moods, always trying to guess what he'll do next. They are, for all intents and purposes, a slave to his emotional whims. The intelligent investor, on the other hand, is his master. You let him rave and panic and rant, and you only engage when his price serves your long-term plan. You make Mr. Market your servant.
Every single day, Mr. Market knocks on your door with an offer. He's out there right now, quoting a price for your investments for every single stock in the world. He's euphoric about some, terrified of others. Now that you understand his game, the only question left is, what are you going to do about it?
All right, let's talk about something that affects millions of us. Investment funds. This is where a huge chunk of our retirement savings, our kids' college funds, well, where it all lives. The stakes are incredibly high. So today, we're going to cut through the noise. We'll blend some timeless, hard-won wisdom with some really powerful data to give you a solid framework for making smart, intelligent choices in this world. Here's what we've got on tap. We'll start with a quick tour of the fund universe. Then we're going to dive deep into the performance trap. It's a big one. We'll explore exactly why today's hot funds so often turn into tomorrow's duds. From there, we'll look at the intelligent solution, which is backed by some serious data. And we'll wrap it all up with a practical checklist for anyone who wants to try picking their own active funds. Okay, first things first, the fund universe. You know, before you can even think about investing intelligently, you've got to know the lay of the land, right? You need to speak the language. So what are we actually talking about when we say the word fund? So, at its heart, an investment fund is a really simple but kind of brilliant idea. Think of it like this. A company gets a bunch of people, you, me, your cousin, the guy down the street, to all chip in and pool their money together. Then, with that big collective pot of cash, they go out and buy a whole bunch of different investments, like stocks and bonds. The magic words here are pooling and diversification. It means that even with just a little bit of money, you can own a piece of a professionally managed, widely diversified portfolio, something that would be a huge headache, if not impossible, to build on your own. Now, funds come in two main flavors. On the left, you've got your open-end funds, which most of us know as mutual funds. They can just create new shares whenever a new investor comes along. You're buying directly from the fund company. On the right, though, are closed-end funds. They have a fixed set number of shares, and those shares trade on the stock market just like shares of Apple or Ford. Investors buy and sell them from each other. Now, this might seem like a small technical detail, but hang on to it. It's going to be really important later on. And here is another distinction that is absolutely critical. It's about how you pay to get in the door. Load funds hit you with a sales commission, sometimes a pretty hefty one, right off the top. That money doesn't get invested for you. Nope, it goes right into the pocket of the person who sold you the fund. No load funds, on the other hand, skip that completely. There's no sales charge. 100% of your money goes to work for you from the very first day. You can see how that gives you a much, much better start. Okay. Basics are covered. Now we're going to tackle the single biggest, most seductive, and most dangerous mistake that investors make. I'm talking about chasing past performance. It's so tempting.
And to really understand the danger, we need to step back in time and look at a powerful, cautionary tale.
Man, this quote just hits the nail on the head, doesn't it? The idea of some hotshot manager promising you the moon is not new. It's a story as old as markets themselves. And as history shows us over and over again, it's a story that almost never ends well for the people who fall for the hype. So let me tell you a story. Our main character is the Manhattan Fund. Back in the swinging 60s, this was it. This was the hottest ticket in town. It was a so-called performance fund, which basically means its whole strategy was to shoot for the stars. The hype was so massive that at its launch, it pulled in $247 million. That was an unbelievable amount of money back then. Everybody, and I mean everybody, wanted in.
And for a little while, it looks like the hype was real. I mean, look at this. In 1967, the fund shot up an incredible 38.6%. The rest of the market only did 11%. People thought they had found a miracle worker. But then the bottom fell out. Their risky bets went south. Two of the fund's biggest investments actually went bankrupt. Just like that, the magic show was over and the lights came on. And here's the real kicker. This is the part of the story that should make you angry. The regular investors who piled in chasing those big returns, they got wiped out. They suffered devastating losses. But the founder, the guy who started it all, oh, he did just fine. He sold his piece of the management company for more than $20 million. You see the problem? The investors took all the risk, and the manager walked away with all the reward. This isn't just a story about one bad fund, it's a timeless warning about chasing hype. Now, it's easy to look back at the Manhattan Fund and just write it off as a crazy fluke from a different era. But it wasn't. It's just a really dramatic example of a pattern that we see again and again and again. The truth is, most funds that have a spectacular year find it nearly impossible to repeat that success. And there are some very real structural reasons why that is.
So this is the million-dollar question, isn't it? What gives? If a manager is a genius one year, why aren't they a genius the next year and the year after that? Is it just that their luck runs out? Well, it's a bit more complicated than that. You see, success itself creates powerful forces that actually start working against the fund. Here are the 4 big hurdles. First, you get what's called asset elephantiasis. Success brings in a tidal wave of new money, and the fund gets so big it can't move quickly anymore. It's like trying to turn an oil tanker instead of a speedboat. Second, star managers get poached. A rival firm offers them a mountain of cash, and they leave you and your money behind. Third, costs go up. Trying to buy and sell huge blocks of stock is expensive, and those costs eat directly into your returns. And finally, you get this sheepish behavior. Managers get so focused on protecting the giant pile of fees they're now collecting that they stop taking smart risks. They just buy the same big, popular stocks as everyone else to avoid looking bad.
Okay, so we've looked at the trap. We understand why it's so hard for winners to keep winning. It all sounds a little bleak, right? Well, here is the good news. There is a way out. There is an intelligent solution. And it involves turning your back on the exciting stories, the slick marketing, and instead focusing on the cold, hard, predictable data. Now, take a deep breath and just look at this table. Seriously. This, to me, is one of the most important pieces of information an investor can ever see. In any given year, picking a fund that beats the market is basically a coin toss. But look what happens as you stretch out the clock. After 10 years, less than a third of funds have kept up. And after 20 years, wow, fewer than 15% manage to beat a simple market average. The longer your time horizon, the more the odds are stacked against you. It's a loser's game. So if trying to find that rare needle in the haystack is a losing proposition, what's the alternative? What if you just bought the whole haystack? And that, my friends, is the simple genius of the index fund. Instead of trying to pick the winning stocks and avoid the losers, an index fund just buys all the stocks in a big market index, like the S&P 500. Its goal isn't to be a hero. It just wants to match the market's performance. And because it's so simple, it can do this for a ridiculously low cost. And this, right here, this chart shows why cost is everything. Let's say you put 10 grand into a low-cost index fund. Over 20 years, it grows to about $36,000. Not bad. But that same 10 grand in a typical high-cost active fund, it only grows to $20,000. That's a $16,000 difference. That's a car. That's a year of tuition. It's wealth that should have been yours, but it got eaten up by fees instead. This is why costs are, without a doubt, the single best predictor of how your investments will do over the long haul. Look, the data makes a pretty overwhelming case that for most of us, a simple, cheap index fund is the smartest way to go. I get that. But I also know that some of you are still thinking, yeah, but I think I can find one of the good ones. I can pick a winner. And you know what? That's okay. But if you're going to go hunting for that rare gem, you can't go in blind. You need a disciplined, intelligent framework. So here's where we're going to flip the script on how 99% of people pick funds. Most people start by looking at past performance. We're going to make that the absolute last thing we look at. You start with the one thing you can actually control and predict: expenses. Find a cheap fund. That's step one. Then look at the risk. How much did this thing lose in the last crash? Can you honestly handle that kind of drop? Third, check out the manager. Do they have their own money in the fund? And then, and only then, at the very end, you can take a quick glance at performance. And you're not looking for the hottest fund. You're just making sure it hasn't been a total dog year after year. So here's a quick checklist of the good stuff. You want to see managers who eat their own cooking. They've got a lot of their own skin in the game. You want a fund that is cheap. I know I keep saying it, but it's that important. You want a fund that's not afraid to be different, that doesn't just look like a watered-down version of the S&P 500. A really good sign is a fund that's willing to close its doors to new money to protect its existing shareholders. And finally, the best funds are often quiet. They don't need splashy TV commercials. Their performance speaks for itself. Okay, let's circle back to a bit of that old school wisdom. Remember way back at the beginning, we talked about closed-end funds, the ones that trade like stocks? Well, here's where they can get really interesting. Because their price is set by the market, it can sometimes fall below the actual value of all the stocks they own. It's like finding a dollar bill on sale for 90 cents. Buying a solid closed-end fund when it's trading at a nice big discount is one of the very few genuine bargains you can find in the market. I mean, how perfect is that quote? It really boils everything down to what matters most. Picking a fund isn't a one-night stand. It's a long-term commitment. You're going to have bad years. You're going to have times when you question your decision. And if you're not mentally prepared to stick with your strategy through thick and thin, you're just going to end up hurting yourself. Patience isn't just a nice-to-have in investing. It's your single most powerful weapon. So I'll leave you with this one last question. I want you to go home, look at your own portfolio, and ask yourself this, honestly. Are the choices you're making, the funds you own, the fees you're paying, the way you react to the market, are they designed to build your family's wealth? Or are you just playing the game by Wall Street's rules, chasing hype and paying high fees, and ultimately just building theirs? The answer to that question makes all the difference in the world. All right, welcome to The Explainer. Today we're going to talk about something that's, well, it's absolutely crucial for any investor: the relationship you have with your advisors. This isn't just a small detail. It's a partnership that can literally make or break your entire financial future. So let's really dig in and figure out how to get this right. You know, I love this quote from Montaigne. It's an old story, but man, does it hit home for investors today. It really gets at the core of our biggest challenge, doesn't it? Are we spending all our time staring up at the sky, dreaming of these incredible, out-of-this-world returns, while completely missing the giant rock right at our feet we're about to trip over? It's such a great reminder to, stay grounded. Okay, so that warning about tripping over what's right in front of you, it leads us right into the heart of the matter: the advisor's dilemma. This is a really unique proposition, so let's get into it. Seriously, think about this for a second. Can you name any other business where you walk up to a total stranger and say, "Hey, can you tell me how to make a profit?" It's kind of wild when you put it like that. There's this incredible, almost naive level of trust involved. We're handing over our hard-earned money and asking someone else to make it grow. You just don't see that dynamic anywhere else. And this slide really drives the point home. Look at the difference. If you own, say, a bakery, you're the expert on making money from bread, right? You hire consultants for legal stuff, for marketing, for operations. But in investing, we often outsource the main goal. We're literally asking someone else for the secret sauce to profit. It's a total flip of the usual script. Okay, so before we get any deeper, let's just pause and ask the big question. Do you actually need help? I mean, really, let's look at a few warning signs that maybe, just maybe, you're in a bit over your head. Take a look at this list and be honest with yourself. Did your portfolio get absolutely hammered? I'm talking down 40% or more back in the 2000 to 2002 crash. Do you have no idea where your money goes each month? Is your portfolio just a random jumble of dozens of stocks that all seem to go up and down together? Or, hey, are you dealing with something huge in your life, like starting a business, kids going to college, or taking care of your parents? If you're nodding your head to any of these, it might be time to call in a pro. And listen, there's zero shame in that.
It's just smart. Okay, so let's say you've decided, yep, I need some help. The next question is, where do you even start? The world of financial advice is, well, it's a jungle out there. Let's map out the landscape so you know who you can turn to. First up, we've got what you'd call investment counsel. These are the pros. They're firms that manage your money for you and you pay them an annual fee for that service. Pretty straightforward.
So what's the deal with these guys? Well, the upside is they're typically careful. They're competent. Their number one job is to protect your money, to keep you from making those big, dumb mistakes we're all capable of. But here's the trade-off, and it's a big one. They're not promising to be geniuses. They're not going to promise you they can beat the market. And they're not cheap. You're paying a pretty hefty fee for that prudence. So you're paying for safety, not for fireworks.
All right, next up, brokerage houses. For most people, this is probably the most familiar face in the game. This is where the majority of the public gets their advice and, of course, where they actually buy and sell their stocks.
But here's where you've got to be really, really careful. There's a built-in conflict of interest with brokers. See, they make money when you trade. The more you buy and sell, the more commissions they make. That can create a culture that's all about speculation, about short-term moves. It's often at odds with a smart, long-term strategy. And notice the language. They have customers, not clients. That's a huge difference. It's a business transaction, not a professional fiduciary relationship.
Then there's another category, financial services. Think of the big names here like Moody's or S&P. You subscribe and they sell you data, bulletins, and reports. So are they any good? Well, it's a mixed bag. On the one hand, they give you a ton of data, and their analysis of the broader economy can be top-notch. But on the other hand, their stock market forecasts can be, let's say, a little vague, kind of like a fortune cookie. They tend to focus on what's happening right now, not the long-term value. So here's the takeaway. They're a great source of information, but you shouldn't rely on them alone to tell you when to buy or sell. They're a tool, not a command.
Okay, so how on earth do you sort through all this and find someone good? It all boils down to one thing: due diligence. You have to do your homework. So let's build your toolkit for how to trust, but verify.
I want this quote burned into your brain. Financial predators, con artists, they all use the same playbook. They are masters at getting you to trust them and just as good at convincing you not to look into their background. Your entire financial future is at stake here. You have to investigate first.
So here's your checklist. These are the non-negotiable, practical steps you have to take. Step 1, Google them. Seriously, Google their name, their firm's name, and add words like complaint, lawsuit, or fine. See what pops up. Step 2, check with your state's securities regulator. Step 3, if they're a financial planner, get their Form ADV from the SEC's website. It's all public info. And Step 4, check their certifications. If they say they're a CFP, go to the CFP board's website and make sure. Don't be cynical, be smart. Never ever skip this.
All right, now for one of the most important parts. You've got to tune your ears to listen for red flags. There are certain phrases that, when you hear them, should make every alarm bell in your head go off.
Hear this? It's a sure thing. Nope, there are no sure things in investing. End of story.
Or this one, guaranteed. The only thing that's guaranteed in the market is risk.
We can beat the market. Oh yeah? Show me the independently audited track record going back years. Don't hold your breath. You need to hurry on this one. That's a classic high-pressure sales tactic, not advice. It means you need to slow down and walk away.
And the big one, trust me. If someone has to say that, you absolutely shouldn't. Trust is earned, my friends, not demanded.
Okay, let's say you've done your homework. You haven't heard any of those crazy red flag phrases. Now it's time for the interview. And here's the thing to remember. You're not just interviewing them. They should be interviewing you too. It's a two-way street.
So here are the questions you need to ask. And don't be shy. What's your investment philosophy? How exactly do you get paid? Anything over 1% of my assets is a big yellow flag. And my favorite, what do you do when one of your investments has a bad year? If their answer is sell it immediately, that's a deal breaker. You need to know their philosophy, their incentives, and their temperament.
And this is just as important. A good advisor is going to grill you too. They'll ask you tough questions. Why do you think you need my help? What keeps you up at night financially? How did you feel the last time the market crashed? See, they're trying to figure out if you are a good fit for them. They're interested in your psychology just as much as your money.
And all of this brings us to the final point. And honestly, it might be the most important concept in this entire explainer. The real reason you hire an advisor. Well, it's probably not what you think.
Just read that quote for a second. You hire an advisor, not to manage money, but to manage you. That's it. That's the whole ballgame. The best advisor in the world isn't valuable because they pick winning stocks. They're valuable because they stand between you and your own worst impulses. They're the person who stops you from panic selling at the bottom or getting too greedy at the top.
So how do they do that? They build systems with you to protect you from yourself. Things like a comprehensive financial plan, a written investment policy statement. These aren't just boring documents to file away. No. This is your financial constitution. It's the playbook you both agreed on when you were calm and rational, so you have something to turn to when the market goes nuts and your emotions are screaming.
Which brings us to the final, ultimate question for you. Let's say you do all this work. You find the perfect guide. You create the perfect plan. Are you actually prepared to listen to them? Especially in those moments, and they will come, when every fiber of your being is screaming at you to sell everything and run for the hills. Because the best advice in the world means nothing if you don't have the discipline to follow it when it's hardest.
You know that feeling? You look at the stock market and it's just this overwhelming wall of noise and hype? It's a real minefield out there, trying to pick the right stocks. But what if you had a toolkit, a solid framework designed to cut right through all that chaos?
See, every single investor, whether you're just starting out or you've been doing this for decades, you eventually have to face this one fundamental question. You see a stock that looks interesting, maybe it's price tanked or maybe it's all over the news, but how do you really know? Is it a genuine opportunity or is it a trap just waiting to spring on you? Today, we're going to build a disciplined way to find that answer.
And to do that, we've got to go back to the source. This quote, it's from the father of value investing himself, Benjamin Graham. I mean, the man literally wrote the book on security analysis, and his principles are the bedrock for the toolkit we're putting together today. He believed that if we're systematic, we can get past all the speculation and start making truly rational decisions. So let's see how he did it.
So here's the game plan. First, we're going to quickly define what security analysis actually is. Then we get to the fun part, building our toolkit one piece at a time. We'll start with a safety check, then we'll move to the valuation engine to figure out what a company's really worth, and we'll finish up with a finely tuned BS detector to judge the people running the show. And then we'll put it all together.
You know, at its heart, security analysis is really just about one thing, swapping pure guesswork for a solid framework. It's a disciplined way of gathering the facts and using them to make logical, informed decisions completely separate from whatever crazy mood the market is in today.
Let's unpack that for a second. The key words in there are examination, evaluation, and estimate. This is basically detective work. It's not about just glancing at a stock price on your phone. No. It's about digging deep into the business itself, really understanding its finances, its competitive landscape, its potential, and maybe most importantly, its risks.
Okay, so this brings us to our very first tool, and honestly, it's the most important one. Before you even dream about how much money a stock could make you, you have to analyze how much it could lose you. This is the safety check. It's all about making sure you're building your investment on a rock-solid foundation.
For Graham, an investor's number one job isn't to find a big winner. It's to avoid a big loser. And you know the fastest way for a company to become a loser? It drowns in debt. So the safety check always starts with a company's financial stability, with a laser focus on how much money it owes.
This table here shows Graham's timeless standards for safety. Now, it looks a bit formal, but it's asking a really simple question. Over the last 7 years, how many times over could the company's earnings have paid its annual interest bill? Look at industrial companies. He demanded that its earnings cover interest payments a whopping 7 times. That creates a huge cushion, making sure the company can handle a rough patch without going under. So we can take those same ideas and apply them today by looking for some modern red flags. For instance, is debt more than half the company's entire capital structure? Or is the company what you might call an OPM addict, totally hooked on other people's money? Are they constantly selling new stock or borrowing just to keep the lights on? You can check this in the cash flow statement. If you see that cash from financing is what's consistently keeping the business afloat, that means the actual operations aren't making enough money. And that, my friend, is a massive warning sign.
All right, so let's say a company passes our safety check. Now we can fire up tool number 2, the valuation engine. We figured out it's probably not going to go bankrupt on us. But now comes the big question. What is this business actually worth?
This is where we learn to separate a company's price tag from its true underlying value. Graham offered this surprisingly simple formula as a great starting point. Just think of it in two parts. First, you've got your baseline. He figured that a company with zero growth is probably worth about 8.5 times its earnings. Simple enough. Then you add the growth factor. For every single percentage point of expected annual growth, you add another 2 to that 8.5 multiplier. It's a really elegant way to connect what a company is earning today with its potential for tomorrow.
But, and this is a big but, that formula is only as good as the growth rate you plug into it. And trust me, not all growth is created equal. You have to learn to tell the difference between a sprinter, a company with a sudden flashy burst of growth that won't last, and a marathoner. The sprinter might be a Johnny One-Note, relying on just one big customer, or it might be a serial acquirer, just buying up other companies instead of growing organically. What you're really looking for is the marathoner, a business with steady, sustainable growth that's protected by a wide competitive moat.
So what does one of these moats look like in the real world? Well, it's any kind of durable competitive advantage that protects a company from its rivals. It could be an iconic brand that's so strong, people literally tattoo it on their bodies, like Harley-Davidson. It could be massive economies of scale, like Gillette making billions of razors so cheaply that nobody can touch them on price. Or it could be a unique intangible asset, like Coca-Cola's secret formula. Even just being a business that's hard to replace, like your local utility company, can be a moat. These are the things that create real, long-term value.
And that brings us to our third and final tool. And this one is so important, the BS detector. Okay, so we've checked the financials for safety, and we've estimated the value. Now we have to analyze the most unpredictable factor of all, the people. Are the folks running this company trustworthy partners, or are they just in it for themselves?
First thing you have to ask is management greedy? Look for stuff like obscenely high CEO pay that has nothing to do with how the company's actually performing. A huge red flag is when they reprice stock options. That's basically when executives get a risk-free do-over on their worthless options, a luxury that you, the shareholder, do not get. And you want to watch out for a big option overhang. All that means is there are a ton of potential new shares that could be created from executive stock options, which will dilute your ownership and shrink your piece of the pie.
Next question. Are they selling out on you? You can look at public records. SEC Form 4 is the one, and see if insiders are buying or selling stock in their own company. Look, one person selling might just be for personal reasons, whatever. But when you see repeated large sales from multiple executives, that's a clear signal. It really begs the question, right? Why should you be buying if the people who know the company inside and out are selling? Also, be super skeptical of companies that buy back their own stock at record high prices. A lot of times, that's just a trick to prop up the price so insiders can cash out their options at the top.
And finally, you have to figure out if you're investing with managers or with promoters. A manager focuses on running the business for the long haul. A promoter, they're obsessed with the stock price right now. Promoters are always complaining that the stock is undervalued. They play the quarterly earnings game with Wall Street. They're like hypochondriacs, putting out a press release for every little thing. And they often use confusing pro forma accounting, which is just a creative way of presenting the numbers to make bad results look good.
It really all comes down to this. You want to partner with the doers, the managers who are focused on building the business, generating cash, and creating value for the long term. You want to avoid the talkers, the ones who are more interested in pumping up the stock than actually running the company. In the end, it's actions, not words, that truly matter.
Okay, so we've built our 3 essential tools, the safety check, the valuation engine, and the BS detector. Now, how do we put them all together into a process that actually brings some clarity to our investment decisions?
The process is actually pretty simple, and it follows a very clear, logical order. First, and always first, you run the safety check. If a company is financially unstable, nothing else matters. You just stop right there. If it passes that test, then you can fire up the valuation engine to get an idea of what it's worth. And finally, before you ever think about buying, you engage that BS detector to make sure you're partnering with honest, capable people.
Now, it is absolutely critical to remember what this toolkit is and what it isn't. This is not a crystal ball. It will not perfectly predict the future because, well, nothing can. What this is an intellectual framework. It's a disciplined process that's designed to help you make rational decisions, to ground you in facts and logic, and most of all, to help you avoid the biggest and most costly mistakes.
And that really brings us to the final question, the one you have to ask yourself. The market is always going to be driven by compelling stories, exciting hype, and fast-moving trends. It's incredibly easy to get swept up in all of it. The real challenge is this. In a world full of stories, are you willing to ignore the noise, open up the toolkit, and do the actual work of analysis? The answer to that question is probably going to define your results as an investor.
All right, let's dive right in. We're going to talk about one of the most important and, often one of the most misleading numbers in the entire world of finance, earnings per share. Yeah, it's that big number that grabs all the headlines, the one that moves markets. But as we're about to see, the real story is almost never that simple.
This quote just hits the nail on the head. It perfectly captures what we're talking about today. Companies, through their financial reports, they love to present a version of reality that only shows the good stuff, only the sunny hours. Our job, as smart investors, is to find the full story, whether it's rain or shine. Okay, here's the game plan. First, we're going to break down the whole illusion of a single earnings number. Then, we'll open up a classic case file from 1970 to see these tricks in the wild. From there, we'll jump to today and see how the game has changed. We'll look at some of accounting's more creative moves, and then I'm going to give you a detective kit to spot this stuff yourself, and we'll wrap it all up with the big picture takeaway. So let's get our first rule straight. That single earnings per share number you see in a headline, it's almost never the whole story. Seriously, you got to think of it like the cover of a book, not the book itself. And believe me, there is a massive incentive to make that cover look as shiny as possible, from Wall Street pressure to, those big executive bonuses. To really get what's going on with the company, we have to open that book and start reading the fine print.
To see how this really works, we're going to jump in a time machine. We're going back to 1970 to look at a financial report from the Aluminum Company of America. You probably know them as Alcoa. This case is just a brilliant example of how a simple, single number can hide a much, much more complicated reality.
So this was the number. This is what investors saw first, $5.20 per share. Now, you have to remember, 1970 was a recession year for the aluminum industry. So this number, it looks pretty darn solid. It made the company look tough, resilient. But right next to that big, bold number was a tiny little footnote. A clue, really, inviting us to dig just a little bit deeper. And of course, when we follow that clue down into the footnotes, we find two really important things. First, this idea of dilution. So what is that? Well, it happens when a company has things like bonds or stock options that can be turned into brand new shares. Just think of it like this. It slices the company's earnings pie into more pieces. The pie itself doesn't get any bigger, but each slice, each share, gets a little bit smaller. And second, and maybe more importantly, there were these huge special charges, big costs that the company really, really wanted investors to just pretend were a one-time thing and ignore completely.
Okay, now this is where it gets really interesting. This slide just lays it all out, all the different versions of Alcoa's earnings for that one year. We start with that headline number, $5.20. Now, once you account for all that potential dilution, it drops to $5.01. If you ignore the dilution, but you do include those special charges, you're down to $4.32. But if you do what a real analyst should do, and you account for everything, both the dilution and all those charges, the earnings number just plummets to $4.19. That is almost 20% lower than the headline. I mean, just imagine a company's profits being a fifth less than what they first told you. That's a huge deal for any investor.
And this is the whole point, right? Which one of these is the real number? I mean, the company gave you 4 of them. By creating all this confusion, they can kind of nudge Wall Street and regular investors to focus on the prettiest number, the $5.20, while the much more realistic $4.19 gets buried deep in the report. It's a game, a strategy that helps them meet those analyst expectations, and yep, it can make a big, big difference in how much management gets paid.
All right, let's fast forward a bit and see how this whole thing evolved. The game Alcoa was playing back in 1970, that was just the warm-up act. In the decades that came after, especially during the tech boom of the late 90s, the pressure to hit those quarterly numbers got so intense, and the accounting games, well, they got a lot more creative and, frankly, a lot more aggressive.
This brings us to the rise of what's called pro forma earnings. Now, the original idea wasn't so bad. It was supposed to show what results might look like without some truly crazy one-time event, like a factory burning down. But it really quickly turned into, this. It became a way for companies to just present a fantasy version of their results, basically asking you to ignore all the bad stuff that actually happened.
And I mean, it just got completely absurd. Take a company called InfoSpace. They asked investors to just ignore almost $160 million in dividend payments. That's real cash paid out to shareholders. Then you had BEA Systems, who pretended they didn't have to pay nearly $200 million in payroll taxes. You know, a basic cost of doing business for literally every company. But the most jaw-dropping example might be JDS Uniphase. They actually presented a pro forma profit by asking everyone to just ignore $2.5 billion in very real costs. It's like financial reporting by playing make-believe.
So, beyond that whole pro forma fad, which was so obvious it was almost funny, there are other, more subtle accounting shenanigans that every investor needs to have on their radar. These are the tricks that get buried deep in the financial statements, the ones that can puff up a company's profits without you even noticing.
A classic example of this is a little trick called aggressive revenue recognition. Take Quest Communications. So they publish phone directories, right? And they just decided to book all the ad revenue for the entire year on the very day the phone book came out. They just completely ignored the fact that their customers paid them for those ads in little monthly payments over the whole year. With just that one accounting change, poof, they magically boosted their net income by $240 million. It was profit that didn't even really exist yet.
And there are other red flags you gotta watch for. Capitalizing expenses is a big one. A company called Global Crossing took its normal, everyday operating costs and, instead of letting them reduce profits like they should, they just called them assets and stuck them on their balance sheet. That simple move hid hundreds of millions in cost from their income statement. Now here's another one, playing games with pension plans. SBC Communications generated 13% of its entire profit one year simply by raising the assumed future return on its pension investments to a wildly optimistic 9.5%. Think about that. It was income created not from selling phones or services, but from a number they just made up on a spreadsheet.
So, with all these traps and tricks and shenanigans, how can you, the investor, actually figure out what's real? It feels complicated, I know, but there are a few simple, practical tools you can add to your own detective kit to protect yourself.
So the first step is to completely flip how you look at a financial report. Don't start on page 1 with the CEO's sunny letter to shareholders. No, you start at the very back and you work your way forward. Companies know most people don't read to the end, so that's where they hide the really revealing stuff. And your first, most important stop is the footnotes. Specifically, you're looking for one section, the summary of significant accounting policies. That's where the company has to tell you the rules of the game they're actually playing.
And as you're reading those footnotes, you've got to keep your eyes peeled for these specific red flag words. Words like capitalized, deferred, or restructuring can be clues that expenses are being hidden or just moved around. And words like began, change, or however are signs that the company has changed its accounting rules. Now look, seeing these words doesn't automatically mean something crooked is going on, but they are absolutely giant, blinking neon signs telling you that you need to stop and dig a lot deeper.
And finally, maybe the most powerful tool you have in your kit is to just stop obsessing over a single year's results. It's a snapshot, that's all. By calculating a company's average earnings over a long period, I'm talking 7 to 10 years, you can smooth out all the bumps from the business cycle, and more importantly, you can iron out the impact of most of these so-called special charges and other accounting games. It gives you a much, much clearer view of a company's true sustainable earning power.
At the end of the day, this whole investigation, it isn't just about finding the one correct earnings number, because often there isn't one. The real goal here is to use a company's accounting choices as a window into its soul, to really understand the character and the quality of the people running the show.
I mean, this quote from the great bluesman Bo Diddley just says it all, doesn't it? An investor can lose way more money from a misleading financial statement from a pen than from almost any other thread out there. The numbers tell a story, and we just have to learn how to read between the lines.
So I'll just leave you with this final thought to chew on. If a company's management is consistently, year after year, choosing the most aggressive, the most flattering, and the most confusing accounting methods they can find, what does that tell you about their character? If they're willing to play games with the numbers they report to you, their owners, what else might they be willing to do? It's a question of trust, and at the end of the day, that might be the most valuable asset a company has.
You know, in the stock market, there's this battle that has raged for generations. It's a real tug-of-war between quiet, predictable strength and the absolutely intoxicating allure of a rocket ship promise. Today, we're going to dive into that battle and see what happens when those promises either blast off to the moon or come crashing right back down to Earth. So this quote from an Air Force general, it's the perfect metaphor for investing. In aerial combat, your 6 o'clock is your biggest blind spot. It's what's sneaking up behind you. And in the market, when a stock feels unstoppable and the story just sounds perfect, well, that's your most dangerous moment. That is exactly when you have to check your 6 for the risks everyone else is completely ignoring.
All right, so here's our game plan. First, we're going to define this timeless battle. Then we'll take a trip back to the 1970s and see how a legendary investor navigated it. After that, we'll fast forward to the absolute frenzy of 1999 to watch history repeat itself, see the spectacular unraveling that followed, and then, most importantly, pull out the essential lessons for you today. And that brings us right to the heart of it. At its core, investing is really a choice between two fundamentally different philosophies, two totally opposing ways of looking at the future. On one side, you've got value investing, buying solid, proven businesses at a sensible price. Think slow and steady wins the race. And on the other side, that's glamour investing, paying a premium, and sometimes a gigantic one, for an incredible story and the promise of explosive growth. It's the reliable business versus the thrilling story. And believe me, this tension is what drives so much of the market. Now, to see this conflict in action, we've got to jump in the time machine and head back to the 1970s. We're going to look at a simple but absolutely brilliant test run by none other than Benjamin Graham, the man everyone calls the father of value investing. Graham picked out 4 companies, more or less at random, right from the stock exchange list. They were a mix of manufacturing and services, nothing too special really, just a regular cross-section of the American economy back then. Okay, now just look at the massive gap on this chart. The market was willing to pay nearly $40 for every single dollar of earnings from the glamour pair, Emerson and Emery, that's that tall bar on the right, but for the value pair, ELTRA and Imhart, they'd only pay about $11. That huge difference in height, that's the premium investors were paying for a good story. So after Graham dug into the financials, their stability, their growth, his conclusion was classic Graham. It was clear and it was prudent. He preferred the cheaper pair. Not because he thought they were going to shoot to the moon, but because their low price gave him a margin of safety. He saw them as reasonably protected investments, totally unlike the high flyers whose prices were just packed with risky hopes and dreams. Now, buckle up, let's jump forward almost 30 years, right to the peak of one of the biggest market manias in history. In 1999, this exact same dynamic came roaring back, but this time the stakes and the hype were dialed up to 11. For our 1999 comparison, we've got a new set of 4 companies. Notice anyone familiar? Yep, Emerson Electric is back, the lone survivor from Graham's original test. Alongside it, we have EMC, a data storage giant, Expeditors, a global freight company, and Exodus Communications, a red-hot web hosting provider right at the heart of the internet boom. To get a sense of just how insane this era was, just look at this number. If you had put $10,000 into EMC at the start of the 1990s, by the end of 1999, you'd have over $8 million, an 81,000% return. It really, truly felt like the party would never, ever stop. This slide gets right to the heart of the mania's psychology. These hot stocks, like Exodus, were constantly splitting. A 2-for-1 split is simple. You get 2 shares for every one you owned, but each one's worth half as much. Your total investment value doesn't change one bit. It's just like trading a dime for 2 nickels. But back in 1999, just the feeling of having more shares made people act richer, and they'd go and bid the price up even higher. It was pure psychology. And this led to some truly wild beliefs. This is an actual quote from an Exodus shareholder on an online message board back then. It sounds comical now, right? But it's a perfect snapshot of the irrational exuberance that had completely taken over. The basic math of a stock split was just totally lost in the hype. So, with all this excitement swirling around, let's do what Ben Graham would have done. It's time to check our 6 o'clock. Let's pop the hood on these 4 companies and see if the reality actually matched the hype. Okay, the contrast here is it's staggering. It's night and day. On one side, you have Emerson Electric, the old economy stock. Sure, it was boring, but it had 42 consecutive years of rising earnings. It was a money-making machine. On the other side, you have Exodus, the market darling. It lost over $100 million, was buried in debt, and was burning through cash like you wouldn't believe. And yet, guess which one the market loved? And the comparison between our other 2 companies is just as revealing. Expeditors was this little-known freight company, but it was growing like a weed without any debt, and its profit margins were actually getting better. Then you have the superstar EMC.
Its stock was priced at over 100 times its earnings. And when you looked closer, its amazing growth was mostly coming from buying other companies, while the profitability of its actual business was slowly slipping away. The warning signs were right there, hiding in plain sight.
So what we have here are two solid, profitable businesses on one side and two glamour stocks with shaky foundations priced for absolute perfection on the other. The stage is set. The bubble is stretched to its limit. So what happened next? This is the story of the great unraveling. This timeline just tells the whole story, doesn't it? As soon as the market turned in 2000, the paths of these companies split dramatically. The value stocks, Emerson and Expeditors, they held their ground. They were resilient because their prices were actually based on real profits. But the glamour stocks, EMC and Exodus, which were priced on a perfect story, just collapsed as soon as that story started to fall apart. And here it is, the final scorecard. The results are just brutal. Over the next 3 years, the two value companies weathered the storm. Emerson was basically flat, while Expeditors, the quiet grower, surged an incredible 51%. And the glamour stocks? EMC lost nearly 90% of its value. As for Exodus was a total wipeout. The company that was supposed to go to infinity and beyond filed for bankruptcy. The shares that investors were frantically buying for hundreds of dollars just 2 years earlier became effectively worthless. The exciting story had a very, very tragic ending. All right, so after all that drama, what's the big takeaway? What can we learn from this incredible tale of two markets? Let's distill Graham's timeless wisdom into some clear lessons for any investor in any market.
You know, Benjamin Graham didn't just point out the dangers. He actually gave investors a toolkit to deal with them. These are his 7 rules for a defensive investor. And notice, they have nothing to do with exciting stories or hype. They're all about real, tangible things: a company's size, its financial strength, a long history of making money, and, this is crucial, not overpaying based on clear metrics like the company's net assets and its average earnings. This is his checklist for avoiding disaster.
Look, if there is one single thing you take away from all this, let it be this. Even a wonderful business can be a terrible investment if you pay too high a price for it. The price you pay ultimately determines your return. That excitement for future growth, that herd mentality, can cause you to pay for that growth 10 times over, leaving you with absolutely no margin for error if things don't go perfectly. And that brings us right back to today. The names have changed, the technology is different, but the human psychology, our attraction to a great story, our fear of missing out, that is exactly the same. So I'll leave you with this question. When you look at the market right now, which companies are the steady performers and which are the exciting stories? And maybe more importantly, which one have you bet on? Thanks for joining me.
All right, welcome to The Explainer. Today, we're going to dig into an investing blueprint that has, believe it or not, stood the test of time. This isn't about chasing the latest hot stock or taking some wild gamble. No, this is about building real wealth with a strategy that's disciplined, way safer, and frankly, just smarter. So let's start with a question that I think keeps a lot of people up at night. How do you actually use the stock market to grow your money without that awful feeling in your gut that you're just at a casino, gambling it all away? And you know what? This isn't a new problem. This has been a challenge for centuries. I love this quote from Sir Francis Bacon because it just nails the idea. It's about making sure that your big moves, your adventures, are backed up by solid, undeniable certainties that can protect you if things go south. To find that balance, we have to turn to the master himself, the legendary Benjamin Graham. This is the guy who basically invented value investing, and he created this incredible framework specifically for what he called the defensive investor. Now, the whole philosophy here is a total mindset shift. It's not about trying to find the next Amazon before anyone else. Forget that. The real goal is to avoid the big, catastrophic mistakes. It's about building a portfolio that can weather any storm, because it's built on a foundation of clear, logical rules. So how did he do it? Well, there were no crystal balls, no secret formulas, no hot tips. He built a rigorous 7-point checklist. Think of it as a filter that screens companies based on things you can actually measure, making sure you're buying quality and, just as important, not paying too much for it. Okay, here they are, Graham's 7 sacred rules. Think of this like a gauntlet a company has to run to prove it's worthy of your money. You can see he starts with the basics, right? Is the company big enough? Is it financially strong? Then he looks at its history.
Does it have stable earnings and a long track record of paying dividends? Only after a company passes all those quality checks does he even begin to think about the most important part, the price. So those first few rules are all about one thing, quality. Graham was looking for companies with real endurance, not some flash in the pan. And he was specific. He wanted a big financial cushion, assets that were at least double the liabilities. He demanded a full decade of profits, year after year. And maybe most impressive, a 20-year unbroken streak of paying dividends. Think about that. A company that can do that isn't just lucky. It's a tough, resilient, all-weather business.
So, you found a great company. It's solid, it's stable, it's passed all the quality tests. You're done, right? Not even close. For Graham, this is where the real work and the real genius begins. Because a great company is only a great investment if you buy it at the right price. It is all about the price tag. His first rule on price had to do with the PE ratio. Basically, how many dollars are you paying for $1 of the company's earnings? Graham put a hard cap on it, 15. He said you shouldn't pay more than 15 times what a company earned on average over the past 3 years. Anything more than that, and you start paying for hope and hype, not for actual proven results.
And he didn't stop there. His second pricing rule was just as tough. It deals with the price-to-book ratio. Now, think of book value as the fire sale value. If the company had to sell off all its physical stuff tomorrow, its factories, its equipment, its inventory, what would be left over? Graham said the price you pay for the stock shouldn't be more than 1.5 times that liquidation value. He wanted to own real stuff, not just a good story. Now, you might be thinking, wow, that is incredibly strict. You'd never find any stocks that pass both of those tests. And you know what? Graham was a realist. He knew that too. So he came up with this really elegant, really clever way to give his system a little bit of flexibility. And this is it, his brilliant little solution. He said you can multiply the PE ratio by the PB ratio, and as long as the result is less than 22.5, you're in the clear. This creates a fantastic trade-off. It means a company that's really cheap on an earnings basis could be a little more expensive based on its assets, or vice versa. It gives you some much-needed wiggle room. It's just genius. Okay, that's the theory. It all sounds great on paper, but we all know theory is one thing and the real world is another. So did this stuff actually work? Let's hop in a time machine and go back to Graham's own era, the early 1970s, and put the blueprint to the test. So back then, all the cool kids were invested in the big industrial stocks, the darlings of the Dow Jones, but when you ran them through Graham's filter, well, they were pretty expensive. They barely passed his tests. But if you looked over in this boring corner of the market, public utilities, you found a gold mine. They were cheaper, they had higher dividend yields, they were basically the perfect stocks for a defensive investor, hiding in plain sight. All right, fine, it worked 50 years ago. That's ancient history in the world of finance. The market has changed completely. So that brings us to the million-dollar question. Does any of this have any relevance at all for us today? Well, first things first, we have to adjust for the times. The principles are timeless, but the raw numbers aren't. A company with 100 million in sales was considered huge back then. Today, a better benchmark for a large company would be something like, say, $2 billion in market value. The scale has changed, but the idea of focusing on established players hasn't. And look at this. This chart is absolutely fascinating. This is data from 2003, right after the dot-com bubble burst, when everyone was screaming that value investing is dead. But look, even in that environment, hundreds of America's biggest companies still pass Graham's strict price tests. Over 140 of them passed his blended rule. It just goes to show you, the opportunities are always there if you have the discipline to look for them. Now let's be honest. Screening hundreds of stocks using these 7 rules, that's a lot of homework, and who has time for that? But what if there was a way to capture the spirit of Graham's defensive philosophy, the safety, the discipline, without doing all that heavy lifting yourself? Well, for the modern investor, there absolutely is. Just think about the stock market today. It's this enormous, sprawling haystack with thousands and thousands of stocks. And the whole financial world is telling us to go out there and find that one magic needle, that one superstar stock that's going to change our lives. The truth is, that's practically impossible. It's a game stacked against us. So why are we even playing that game? Why are we spending all our time and energy looking for that one tiny needle, with all the risk that involves, when we could just own the entire haystack? And that's exactly what an index fund lets you do.
It's the perfect modern-day tool for Graham's defensive investor. For an incredibly low cost, you get to own a tiny piece of almost every company out there. You are guaranteed to own all the winners because you own the whole shebang. It's automatic diversification, it's safety on autopilot. So look, whether you decide to roll up your sleeves and use Graham's 7-point checklist, or you take the simple, elegant shortcut of an index fund, it all really boils down to one fundamental choice. It's a choice about your core investing philosophy. You're either in the business of prediction or you're in the business of protection. Prediction is qualitative. It's about trying to guess the future, betting on a charismatic CEO or a cool new product. It's about stories. Protection, Graham's approach, is quantitative. It's about what you can measure today. It's about paying a price that makes sense right now, which gives you a margin of safety no matter what the uncertain future brings. And that's the question I want to leave you with today. Take a hard look at how you've invested your own money. Forget the hype, forget what everyone else is doing, and just ask yourself that one simple, powerful question. Is my portfolio built for prediction, or is it built for protection? As Benjamin Graham showed us, the answer to that question can make all the difference in the world.
All right, let's dive into the mind of a true legend, Benjamin Graham. Now, this isn't about passive set-it-and-forget-it investing. Oh, no. This is for the active investor, the curious one, what Graham himself called the enterprising investor. It's for anyone who looks at the market and thinks there has to be a smarter way to do this, especially when most of the pros can't seem to get it right.
So, here's our game plan. First, we're going to tackle the big elephant in the room question about whether it's even possible to beat the market. Then we'll get into Graham's absolutely brilliant contrarian philosophy, look at the actual tools he used, see how today's masters have put their own spin on it, and finally, figure out what all of this means for you.
You know, we're going to start with a fact that, honestly, is kind of hard to believe at first. I mean, you'd think the smartest folks with the fanciest degrees and the best computers would consistently win in investing, right? It just seems logical. Well, the data, it tells a very, very different story.
It's actually pretty shocking. When you look at the studies, and we're talking decades of data here, they all say the same thing. The vast majority of professional fund managers, the people who are paid millions to do this one job, fail to beat a simple market average like the S&P 500. They have all the resources in the world, and they still can't outperform a basic do-nothing index fund. So this leads us to a really tough question, doesn't it? If the pros, with their armies of analysts and their supercomputers, can't get an edge, what possible chance do the rest of us have just sitting at home? It's a pretty intimidating thought, and it's the perfect place for our story to really get going.
Well, Graham had a theory on this. He figured it boiled down to two big problems. First, the market is just incredibly efficient. With millions of eyes on the same information, stock prices adjust almost instantly. It's tough to know something nobody else does. But the second reason is the big one. He believed Wall Street's entire approach was flawed. They get caught up chasing hype, buying into exciting growth stories at any price, while running away from unpopular companies, even if they're dirt cheap.
Okay, so if the popular way is broken, what's the alternative? And this is where you see the true genius of Benjamin Graham. He saw everyone else running from these neglected, unloved companies, and he didn't see a warning sign. He saw a massive, flashing neon sign that said, opportunity. This quote right here is the heart and soul of his entire philosophy. Graham's whole career was built on this simple, yet kind of radical idea. To get better than average results, you absolutely cannot do what the average person is doing. You have to find a sound, logical method that nobody else wants to touch. You have to go against the grain. And this lays out the two mindsets perfectly. The crowd chases the exciting story. They're buying hope and future projections. The Graham investor, they ignore the story completely and focus on the cold, hard facts. The goal isn't to buy a great company, it's to buy any decent company at a price so ridiculously low that it gives you a massive cushion in case you're wrong. That cushion, that was his legendary margin of safety. And here's the best part. Graham wasn't just some academic spouting theories. He was in the trenches. He created a real honest-to-goodness toolkit, a systematic process for actually finding these bargain bin stocks. Now, his ultimate prize, the holy grail of bargains, was something he called a net current asset stock. The concept is so simple it's almost funny. Just imagine a company could sell off all its short-term stuff, its cash, its inventory, and pay off every single one of its debts, and still have, say, $8 a share left over. Graham looked for companies like that trading for less than $8 a share. Think about it. You're buying the cash for less than it's worth, and you get the entire ongoing business, the factories, the brand, all of it, for literally less than zero. It's wild.
Now, of course, not every company is that cheap. So for the others, he created this filtering process, a 5-point checklist. He'd start with stocks that just look cheap on the surface and then put them through the ringer. Is it financially healthy? Has it been profitable for a while? Does it actually pay a dividend, proving it has real cash? Have earnings gone up? And finally, is the price still a bargain compared to its hard assets? It's a completely unemotional, mechanical way to hunt for value.
So you might be thinking, that all sounds great for the 1950s, but does any of this stuff still work today? And that's a great question. Finding those classic Graham bargains is definitely tougher now, but the spirit of what he did, oh yeah, it is alive and well with the best investors in the world.
The fundamental principle is timeless. It never changes. The goal is to find value in the places nobody else is paying attention to. You have to go digging through the unloved, the boring, the temporarily messed up corners of the stock market.
So where are these modern hunting grounds? Well, today's masters have a few favorite spots. Some of them love to start with a 52-week low list. I mean, that's literally a list of stocks that everyone hates right now. Others look for what they call 60-cent dollars. Basically, a business that's worth $1, but you can buy it for 60 cents. And almost all of them are obsessed with finding managers who act like they own the place, not like they're just renting it.
And one of the key metrics they use is something called return on invested capital, or ROIC. It sounds fancy, but the idea is dead simple. It ignores all the accounting fluff and asks one powerful question. For every single dollar this company puts to work in its business, how much profit does it spit out? It is just a crystal clear measure of how good a business actually is.
Of course, you absolutely cannot have this conversation without talking about the guy who took Graham's ideas and ran with them, his most famous student, the one and only Warren Buffett.
And this is the critical evolution right here. Graham was the master of buying a decent company at a great price. He'd happily buy a so-so business if it was cheap enough. But Buffett, with a nudge from his partner Charlie Munger, flipped that script. He started to focus on buying a wonderful company at a fair price. It's a subtle but hugely powerful shift from just cheapness to quality.
So what does a wonderful company even look like to Buffett? Well, he wants a business with a huge, protective moat around it, something that keeps competitors away. He wants a business he can actually understand, with rock-solid finances and management he can trust. And then, he just waits. He waits patiently for some temporary bad news to scare everyone else away so he can step in and buy that fantastic business at a reasonable price.
All right, we've seen the problem, we've seen Graham's classic solution, and we've seen how guys like Buffett have updated the playbook. So let's bring it all home. What does all of this mean for you, the enterprising investor?
You know, another investing giant, Max Hein, put it perfectly. There are many roads to Jerusalem. That is the key. There isn't a single magic formula. Graham's quantitative approach worked. Buffett's quality-focused approach works. The secret sauce isn't the specific map you use, it's a discipline to stick to the road you've chosen no matter what.
And before you even think about putting a single real dollar to work, Graham gave this piece of brilliant advice. Just practice for a year. Set up a fake portfolio, make your picks, and, this is the most important part, write down exactly why you're making each decision. Then, after a year, be brutally honest with yourself. Did you beat the market? And maybe even more important, did you actually enjoy doing it? If the answer is no, hey, no harm done. You've just learned a priceless lesson for free.
Because when you really boil it all down, all the great investors share these two qualities. First, they are unbelievably disciplined and consistent. They find a strategy that makes sense and they stick to it, especially when it's out of fashion. And second, they think like they own the entire business, not like they're renting a stock for a few weeks. They could not care less about the market's daily drama.
And that leaves us with the one final crucial question. The knowledge is out there. The playbooks are written. But being a successful, enterprising investor isn't about being the smartest person in the room. It's about having the right mindset, the right emotional discipline. It's about temperament. So looking at everything we've talked about, the real question isn't whether it can be done. It's, do you have what it takes?
Welcome to The Explainer. Today we are diving into an investment that promises, well, pretty much the holy grail. You get the safety of a bond, but with all the exciting growth potential of a stock. But if it sounds too good to be true, you know the rest. Let's dig in and see what's really going on.
So this is the big question, isn't it? It's the pitch that has hooked investors for generations. The dream of getting all that juicy stock market upside, but with none of the scary stomach-churning downside. It's the ultimate free lunch. But as we all know, in finance, there's just no such thing. So let's find out what the real price is.
All right, here's how we're going to break this down. First, we'll look at that seductive promise. Then, we'll get into Benjamin Graham's classic warnings. After that, we'll tackle the tricky conversion dilemma. And then, oh boy, we'll look at something he really hated, warrants. Finally, we'll see how things look today and pull it all together with the big takeaway.
Okay, let's start with that seductive promise. You gotta understand the appeal before you can see the pitfalls, right? And honestly, the core idea is, well, it's really attractive on the surface.
Okay, so the pitch goes something like this. On one hand, you get the safety of a bond. If the company goes belly up, you're higher up in the line to get your money back than the stockholders are. That's a nice cushion. On the other hand, if the company's stock goes to the moon, you can convert your bond into shares and ride that rocket ship up. Sounds amazing, right? But, and this is the big but, Benjamin Graham would tell you there's always a price. You're giving something up to get that sweet deal. Usually it's a lower interest payment, a lower yield than you'd get from a normal bond. Or the bond might just be from a riskier, lower quality company to begin with.
All right, now for Graham's big cautionary tale. And what's so brilliant about it is that it's not really about complicated formulas or spreadsheets. Nope, it's about something we can all understand, people. Specifically, how people act when they get swept up in a crowd.
And this quote, man, it just hits the nail on the head. Think about it. When is it most important to be careful? It's when everyone else is going wild, just tossing cash at whatever's hot. All those sound principles, buying quality stuff at a decent price, they just get forgotten. And that's the exact moment that companies see their chance. They see all this easy money floating around, and they rush out to sell these complicated convertible deals.
And you know what? History shows he was absolutely right. It's a pattern that just repeats itself. Check this out. Every time a bull market is hitting its peak, when everyone's feeling unstoppable, that's when the market gets flooded with these convertible offerings. The dot-com bubble is just a crazy example. Issuance shot up from $15 billion in '99 to, get this, $105 billion in 2001, just as everything was about to fall apart. They were selling these things to the most optimistic people right before the floor fell out.
So what happens when the music stops? Well, it's not pretty. Let's look at the downturn between '68 and '70. Convertible preferreds, they got crushed, lost almost a third of their value. That was twice as bad as regular preferred stocks. But here's the real shocker. It was almost 3 times worse than the drop in the S&P 500. So much for that safety they promised, huh? In this case, it was actually worse than just owning plain old stocks.
I mean, this chart really says it all, doesn't it? Just look at that huge bar on the left. That's the convertibles taking a 32+% nosedive. The promise was protection. The reality? A disaster. It really wasn't the best of both worlds at all. It was the absolute worst. You got all the pain of the stock market drop, and then some, but none of that bond-like safety you were sold on.
Okay, but let's play devil's advocate. Let's say you get it right. You buy one, the stock does great, and now you're sitting on a nice profit. That's the goal, right? Smooth sailing from here? Well, not exactly. This is where a whole new and frankly, really painful mental game begins.
This is what I call the profit paradox. So you buy your bond at 100. The stock does well, and now your bond is worth 125. You're up 25%. So what now? Do you sell and take the win? Because if you do, and that stock keeps screaming higher, you're going to kick yourself. So maybe next time you hold on, thinking, not this time, I'm riding this one all the way up. And then, bam, the market turns and your bond plummets down to 80. Now you've lost money. It's this awful cycle of regret and second guessing that can just paralyze you into making the wrong move every time.
Graham shared this incredible, kind of scary story about a company called Eversharp. Its convertible bonds went through the roof, and everyone, even the so-called pros, got swept up in the excitement. They converted their nice, safe bonds into the much riskier stock right at the very top. And then, you guessed it, the stock completely cratered, wiping them out. That's where that old Wall Street saying comes from. Never convert a convertible bond. The second you convert, you're essentially swapping your safety net for a lottery ticket, and it's almost always at the worst possible moment.
You know, if you thought Graham was tough on convertibles, just wait. He saved his real anger for their, let's call it, ugly sibling, the stock option warrant. To him, warrants weren't just a dumb investment. They were fundamentally wrong, a kind of financial sin.
Yeah, a near fraud, an existing menace, and a potential disaster. I mean, he did not mince words, did he? He basically saw them as financial magic tricks designed to create value from nothing, all to fool everyday investors. So let's unpack why he had such a strong reaction.
So, what exactly is a warrant? In simple terms, it's just a long-term right to buy a company's stock at a fixed price. But the real question is, where does that right come from? Well, it's actually carved out of the value that rightfully belongs to the people who already own the stock. See, as a shareholder, you should have the first crack at buying any new shares the company issues. But a warrant, it takes that right away from you, the owner, and packages it up to be sold to somebody else.
And Graham, being the literary guy he was, drew this amazing parallel to Goethe's Faust. He compared warrants to the scene where the devil, Mephistopheles, convinces an emperor to just print paper money, claiming it's backed by all the gold that's still in the ground. It was basically creating money out of thin air, out of an idea. And just like that imaginary money and the real-life French currency it was based on, it ended up being totally worthless. He saw warrants as the exact same kind of dangerous illusion.
And here's how that sleight of hand actually works in the real world. Warrants can make a stock look a lot cheaper than it is. You know the PE ratio, right? Price to earnings. A low one can make a stock look like a real bargain. Well, by not properly counting all the new shares that could be created by these warrants, a company can show you a nice low PE ratio of, say, 9.1. But once you do the math correctly and account for that dilution, poof, the true PE ratio is actually 14.2. The bargain you thought you saw, it was never really there.
Now look, Graham wrote all this a long time ago, and finance never stands still. So the big question is, have things changed? Is the convertible market today any better, or are we just dealing with the same old problems in a new package? Let's find out.
Well, one of the nicknames convertibles have picked up over the years is stocks for chickens. Kind of funny, right? But the idea is that they're for folks who are a bit nervous about the stock market. They let you get a taste of those stock-like returns without jumping headfirst into the deep end.
And in fairness, the market really has gotten better. The quality is higher now. More than half are investment grade. They don't last as long, which cuts down on some of the volatility, and there are more protections built in for investors. And they've actually held up better in recent downturns. Take the 2002 bear market. Convertibles lost less than half of what the S&P 500 did. So, hey, maybe that stocks for chickens thing isn't so far off after all.
But, and you knew there was a but coming, here's the number you absolutely have to remember. 83%. That's how closely the returns of convertible bonds track the S&P 500. So 83% of the time, they're just doing whatever the stock market is doing. And how much do they act like safe bonds? Only about 30%. So don't let the bond part of the name fool you. When it comes right down to it, a convertible acts a whole lot more like a stock than a bond. It's not some magic mix of the two.
So, after all that, what's the verdict? How should a smart investor think about these things? Let's just boil it all down to a few simple, powerful rules to keep in your back pocket. All right, here are your rules for the road. First, anytime you hear that phrase, best of both worlds, your alarm bell should go off. Always ask, okay, what am I giving up? Second, focus on the quality of the company itself, not the fancy financial product. A shiny convertible bond can't fix a broken business. Third, understand the trade-offs. Know exactly what you're sacrificing in yield or safety. Fourth, if some new, complicated thing becomes all the rage at the peak of a bull market, that's your cue to be very skeptical. And finally, number 5, never forget that warrants are a gimmick. They create imaginary value by taking real value away from you.
And that brings us to our final thought. The next time you're pitched some complex investment that sounds like a guaranteed win, just pause and ask yourself one simple, powerful question. If this is such a home run for me, what does the person selling it get out of the deal? Just thinking through that question. Well, that's what separates a speculator from a truly intelligent investor.
Welcome to The Explainer. Today we're doing a little financial archaeology. We're digging through the graveyards of corporate history. But we're not just looking for old stories. We're hunting for ghosts. Because you know, the very same patterns of collapse that buried giants decades ago, they're still out there, haunting the markets today. We're going to uncover 4 of these ghost stories, and the lessons they teach are, well, they're absolutely critical if you want to avoid becoming a casualty yourself. You know, this quote right here, this is the key to everything we're going to talk about today. It's about a god who sacrifices an eye to learn a great secret, only to be told that the secret is watch with both eyes. In investing, that is everything. See, one eye, let's call it your right eye. It gets swept up in the story, right? The exciting new tech, the promises of a glorious future. But your other eye, your left eye, that's got to be the skeptic. It has to stay glued to the cold, hard numbers. So think of this whole explainer as a training session for your investing left eye.
So here's our game plan, our little tour of financial disasters. We're going to explore 4 really distinct patterns. First up, the tottering giant. Looks solid, but it's about to fall over. Then we've got the reckless empire builder, a company just completely hooked on debt-fueled growth. We'll dive into the chaos of the unbalanced takeover, where a tiny fish somehow swallows a whale. And finally, the hot stock bubble, where a great story completely takes the place of a real business. For each one, we'll look at a classic case and then its modern ghost before we wrap it all up and sharpen that investing left eye.
Okay, let's kick things off with our first pattern. The company that looks absolutely massive, indestructible from the outside, but is actually rotting from within. And its soaring stock price is the perfect camouflage, hiding a dangerously weak foundation.
So for this one, our classic example is the Penn Central Railroad, which was the country's largest railroad back in the late 1960s. Its modern echo, Lucent Technologies, which at the absolute peak of the tech boom in 2000 was one of the most valuable and widely held stocks in America. Both of them looked like titans, and both were heading straight for a cliff.
The crazy thing about Penn Central is that the warning signs were hiding in plain sight. You just had to look at a simple metric called interest coverage. All this does is measure if a company is earning enough to safely cover its debt payments. For a railroad, the safety standard was about 5 times coverage. But look at this. In 1968, with its stock near an all-time high, Penn Central's coverage was less than 2. I mean, this wasn't a red flag, it was a 5-alarm fire, and the whole market was just standing around admiring the smoke.
And the illusion just went deeper. I mean, ask yourself this question. How real are your profits if you haven't paid any income tax in 11 years? Penn Central hadn't, which meant its reported earnings were basically a fantasy, totally inflated because they were missing this huge normal cost of doing business. These were not real profits. The right eye saw a stock that was going up, sure, but the left eye should have seen that the numbers were just a mirage.
Okay, now fast forward 30 years to Lucent Technologies. In the year 2000, it paid $4.8 billion to buy a company called Chromatis Networks. The problem? Well, Chromatis had no customers and 0 revenue. It was a bet on the future so speculative that nearly all of that $4.8 billion had to be classified as goodwill, which is a financial term that in this case was really just a synonym for wishful thinking. It was the exact same pattern, a huge price tag completely disconnected from business reality. Lucent stock would go on to lose 97% of its value.
All right, let's move on to our second pattern and see how these things build on each other. This is the company that gets addicted to acquisitions. It's just obsessed with getting bigger and bigger, funding its shopping sprees with a mountain of debt, and it couldn't care less if the deals actually make any business sense. So for this pattern, we're going to compare Ling Temacovat, or LTV, from the 1960s, a company that really became the poster child for reckless expansion, with Tyco International from the 90s and 2000s. Now, Tyco took this idea of growth by acquisition to a completely different level. They bought companies the way most of us buy groceries. In just 1 year, it bought about 200 of them.
This timeline really shows you the vertigo of LTV's rise. I mean, in the mid-60s, its sales exploded 20-fold. Sounds amazing, right? But the real story is the debt. It went from a manageable $44 million to a staggering $1.86 billion by 1969. This wasn't growth. It was a company building a skyscraper on a foundation of sand, using borrowed money for every single break. The second the economy turned, the entire thing just collapsed. The stock plunged from $169 a share down to $7.
Now check out how Tyco managed its acquisition habit. To hide the true costs of constantly buying and gutting other companies, they used this blizzard of special accounting charges. And they gave them these unbelievable acronyms. You had moron charges, chilla charges, whoopee prod charges. I mean, you literally can't make this stuff up. The whole point was to make these huge expenses look like one-off events, so investors would just ignore them when they were calculating the company's real profitability.
Just look at this chart. An expense that's labeled non-recurring is supposed to be a one-time thing, right? But Tyco's so-called moron charges showed up in 4 out of 5 years.
They added up to $2.5 billion. So let's be real. When a one-time event happens almost every single year, it's not an event. It's just a fundamental cost of your business. This shows that Tyco's real business wasn't making things. It was a machine for buying companies, and these charges were just the cost of fuel for that machine.
All right, our third pattern is one of the most spectacular, especially when it happens. This is when a much smaller company, usually pumped up with an overvalued stock and tons of debt, somehow manages to buy a corporate giant. It's like the financial version of the tail wagging the dog. And believe me, it almost never ends well.
The classic case is from 1969, a small plastics company called NVF Corp buying Sharon Steel, a steel maker 7 times its size. The modern and way more infamous example is, of course, the merger of AOL and Time Warner at the absolute peak of the dot-com bubble. An internet company bought one of the world's biggest media conglomerates.
So the deal was sold as a merger of equals, but this chart right here just shows you what a lie that was. In the real world of actual sales and profits, Time Warner was a giant with 5 times the revenue of AOL. But in the fantasy world of the dot-com bubble, AOL stock was so pumped full of hype that its shareholders got to claim 55% of the new combined company. A business built on promises was literally buying a business built on real assets.
And the executives, oh man, they were euphoric. The hype was just completely off the charts. Time Warner's chairman promised limitless opportunities, especially for shareholders. What they had really just done was trade a massive, profitable, real-world business for a majority stake in an internet company whose value was based on eyeballs and hope, right as that bubble was about to violently burst.
And this was the result. In 2002, just 2 years after the deal closed, AOL Time Warner had to write down the value of AOL and posted a loss of nearly $99 billion. It's still one of the largest single-year corporate losses in history. The limitless opportunities turned into, well, limitless losses.
And that brings us to our fourth and final pattern, the hot stock. This is a company, usually a brand new IPO, whose valuation has absolutely nothing to do with profits or assets or anything real. Its value is based entirely on a story, a trend, or a single magic word that has just captured everybody's imagination.
See, back in 1969, one of the hottest magic words was franchising. A small mobile home seller called AA Enterprises just slapped that word onto its business plan, went public, and the market went wild. 30 years later, in 1999, the magic word was, you guessed it, internet. And a perfect example of this was a company called eToys Inc.
This one slide, this just captures the absolute insanity of the dot-com bubble. Look at eToys, $30 million in sales, and it was losing $1 for every dollar of sales. Now look at Toys R Us, over $11 billion in sales and a healthy $376 million in profit, a real business. And yet, the stock market decided that the money-losing startup was worth almost $8 billion, while the profitable giant was worth only $6 billion. That's not investing. That is a mass delusion fueled by one single magic word, internet.
And the ending for both of these stories was exactly the same. When a company's value is built on nothing but a magic word and a prayer, reality has a very nasty habit of catching up. Both AA Enterprises and eToys were bankrupt within 2 years of their celebrated public offerings, and they wiped out nearly all of their investors' money on the way down.
So, we've walked through the wreckage of 4 pretty clear financial patterns: the tottering giant, the reckless empire builder, the unbalanced takeover, and the hot stock bubble. So what's the big takeaway for you? How do we use these ghosts of the past to protect ourselves today?
It all comes back to training that skeptical left eye. It just means learning to spot these repeating red flags. When you see a valuation that makes absolutely no sense compared to the actual business, be careful. When you see debt piling up at an insane rate, be very, very careful. When the financial reports are filled with confusing jargon and one-time charges that seem to happen every year, you run. And when everyone is screaming about a new, can't-miss trend, that's precisely the time to be the most cautious.
At the end of the day, all these stories teach us the same thing. The most dangerous 4 words in investing are, this time it's different. It's not. The technologies will change, the magic words will evolve, but human nature, greed, fear, and the basic laws of finance, they don't change. Sound investing isn't about staring into a crystal ball to predict the future. It's about looking clearly into the past, seeing the patterns that repeat, and always, always remembering to watch with both eyes. Thanks for joining me.
In finance, there's this one huge question. How does the market really decide what a company's worth? So often it just feels chaotic, right? Driven by headlines and whatever the latest hype is. But what if there's a simple, really powerful metaphor that can cut right through all of that noise? Today, we're going to dive into a timeless analysis that pits the market's darlings against these forgotten, unglamorous workhorses. And in doing that, we're going to uncover a super important lesson about how markets actually work. And this is it. This is our guide for the whole journey. This one brilliant idea from the legendary investor Benjamin Graham, the voting machine versus the weighing machine. This idea is the key, the absolute key, to unlocking why the market can seem so confusing. It's really all about this constant battle between short-term popularity and long-term actual substance. Okay, so before we jump into any specific companies, we have to really get a grip on this core concept. This is the mental model we're going to use to break down every single example that follows. So think of it like this. The voting machine, that's a popularity contest. It's all about sentiment, what's in the news, exciting stories, what's fashionable right now. It's fueled by a herd mentality. Everybody wants to own the thing that everybody else wants to own. It's loud, it's fast, and it's super emotional. Now the weighing machine, that's the complete opposite. It's patient, it's objective, it couldn't care less about stories. It just cares about the cold, hard facts. How much does the business actually earn? What assets does it own? It measures real substance. All right, let's see this thing in action. We're going to wind the clock all the way back to the late 1960s and early 1970s for a classic case study that Graham himself loved to talk about. It perfectly pits a hot story stock against a kind of boring substance stock. On one side, you've got H&R Block. You have to picture it. This was like the tech disruptor of its day. They had this amazing growth story about bringing complicated tax services to everyday people. It was new, it was exciting, and the story was just irresistible. And on the other side, Bluebell, a company that had been quietly making work clothes since 1916. Solid, dependable. But let's be real, there's not much of an exciting story there, is there? And boy, did the voting machine go wild for H&R Block. In 1969, its stock was trading for more than 100 times its annual earnings. Just to put that in perspective, that means investors were willing to pay $100 for every $1 the company made in profit. The market, as Graham put it, was just ecstatic. And Bluebell? Well, the market showed basically no enthusiasm. Its stock was trading at a quiet 11 times earnings. It was completely lost in the shadow of this popular new kid on the block. The votes were in, and H&R Block won by a landslide. So we have seen the results from the polls. The crowd has spoken. They've picked their winner. But now it's time to ignore all that noise, pull out the scales, and actually weigh the businesses behind these stocks. And this is where the weighing machine tells a totally different story. Just look at these numbers. Bluebell, the boring company, had 4 times the business volume. It earned 2.5 times more in actual profit, and it had over 5 times the hard assets on its books. And yet, look at the bottom line. The market valued H&R Block at over 3 times the price of Bluebell. The weighing machine was just screaming that Bluebell was the much bigger, more substantial business, but the voting machine had already crowned H&R Block king. So what happened? Well, in the years that followed, the weight of the actual business started to matter a whole lot more than the story. Bluebell's stock ended up advancing considerably more than H&R Block's. It proved that the investors who trusted the scales over the polls were the ones who were handsomely rewarded. At the end of the day, the weighing machine always wins. It's a great story from, a bygone era. But it's really easy to look at this and just say, okay, sure, that was the 70s. Markets are way smarter now. But are they? Is this just some old-fashioned story, or is it a timeless lesson about human psychology that just repeats itself over and over again? All right, let's fast forward 30 years, right into the absolute heart of the dot-com bubble. The technology was completely different, the names had changed, but as we're about to see, the story was, well, it was exactly the same. History doesn't just rhyme. Sometimes it's a perfect echo. So here are our new players. In this corner, Yahoo, the undisputed king of the new internet age. This was a company that seemed like it was inventing the future right before our eyes. And in the other corner, you have Yum Brands, an old world company that ran fast food chains like KFC and Taco Bell. You see the pattern, right? The revolutionary news story versus the boring, established substance. And the voting machine in 1999? It was an absolute landslide. The market was so completely in love with Yahoo that it valued the company at $114 billion. Yum Brands, in comparison, was valued at just under $6 billion.
That means the market voted that Yahoo was worth almost 20 times more than Yum Brands. 20 times.
But then we pull out the weighing machine, and the numbers here, they're almost comical. I mean, look at this. Yum Brands earned $633 million in profit. Yahoo earned just $35 million. That is over 17 times more profit for the fast food company. So let that sink in. The company earning 17 times more money was valued at a tiny fraction of the one barely making any. The scales weren't just whispering, they were shouting that the market's vote was completely disconnected from reality.
And of course, gravity eventually took hold. The dot-com bubble burst, the voting stops, and the weighing began. And the result was absolutely brutal for the market darling. Between 2000 and 2002, Yahoo's stock lost over 92% of its value. Wiped out. Meanwhile, the boring fast food operator, Yum, brand stock gained over 25%. Once again, substance crushed hype.
So what's the big lesson here? Because these aren't just a couple of interesting stories from the past. They reveal a fundamental truth about what happens when you pay a high price for a promise. A truth that's just as relevant today as it was 50 years ago.
And here's the crucial point. A great company can be a terrible investment, and a kind of mediocre company can be a wonderful one. It all comes down to the price you pay. Yahoo was a revolutionary company, no doubt about it. But at $114 billion, its stock was a catastrophic investment. The quality of the business and the quality of the stock are two totally different things. So how can we actually use this? Well, it really comes down to 3 habits of aware. First, you have to learn to question the story. When everyone is a cheerleader, your job is to be a healthy skeptic. Second, you have to do the simple work of comparing the price to the value. Just ask yourself, what am I really getting for the price I'm paying? And finally, you have to be patient, because popularity comes and goes, but in the long run, substance is what gets weighed.
So, to sum it all up, the market's emotions create these huge gaps between a stock's price and a company's real value. This isn't a rare thing. It's a repeating pattern driven by human psychology. And the key to navigating it all is to discipline yourself to be aware, to focus on what a business is truly worth, not what the crowd happens to think it's worth this week.
And that leaves us with a big question to carry forward. As you look at the market today, with its own set of exciting stories and popular darlings, always ask yourself this. Is this company just being voted for, or is it one that will ultimately be weighed? Because learning to tell the difference, well, that's what separates fleeting speculation from timeless investing. Thanks for joining this explainer.
You know, we spend so much of our time thinking about buying stocks and selling stocks. We look at charts, we read the news, we try to time the market. But we hardly ever stop to ask a much bigger, more fundamental question. What does it actually mean to own a piece of a company? I mean, really own it. It's a question that goes way beyond just watching a ticker symbol bounce around.
You know, decades ago, the absolute father of value investing, Benjamin Graham, was just incredibly frustrated. He looked at investors and he didn't see owners. He saw a passive, silent crowd. As he put it, they were just a complete washout, voting like sheep for whatever management told them to. He felt they had totally given up their most important job as owners.
And this is really the heart of the matter, isn't it? It's the one question we're digging into today. And believe me, how you answer this can fundamentally change the way you invest forever. Because look, if you're just a speculator, you're basically a passenger along for the ride. But if you're the boss, if you're an owner, well then you're in the driver's seat.
Now, Graham didn't just complain about the problem, he gave us a framework to solve it. He believed that being an intelligent owner, a vigilant boss, really just boils down to consistently asking 2 simple but incredibly powerful questions about every company you own.
And it's really that simple. First, are these people any good at their jobs? I mean, are they actually running the business well? And second, and this one is maybe the most important, are they working for you, the actual owner, or are they working for themselves? The answer to that second question, well, that's where things can get really, really interesting.
So, let's see how this plays out in the real world. We'll start with one of the biggest, oldest fights between owners and managers: what to do with the company's profits. Because let's be absolutely clear about one thing. At the end of the day, it's the shareholders' money. It belongs to you.
It's kind of funny. The whole argument for holding on to cash has done a complete 180 over the years. It used to be that the weak companies, the ones who were struggling, held on to every penny. The strong, confident companies, they paid out profits to their owners.
But now, the modern argument, especially from fast-growing companies, is, no, we should keep that cash. We can make more money for you than you can.
And this change in thinking led to what you can only call a daddy knows best culture. You saw this pop up everywhere, but especially in the tech sector. The message from management, whether they said it out loud or not, was basically, hey, don't you worry your pretty little head about all this cash. We're the geniuses here. Just let us reinvest it and we'll make you rich.
And wow, look at this chart. This shows you exactly what happened. The market completely bought into the whole daddy knows best thing. Back in the 60s, most new public companies paid a dividend. By 1999, it had practically vanished, just completely fell off a cliff. Investors were totally convinced to trade actual real cash in their hands for a promise of growth tomorrow.
But here's the question. Did Daddy really know best? Let's take a look at a classic example, Microsoft. By late 2001, they were sitting on a cash pile of $38 billion, and it was growing by $2 million an hour. You got to ask yourself, just how rainy of a day were they preparing for? Could any company really reinvest that much cash efficiently?
Well, when researchers actually dug into the numbers, they found that the data just doesn't back up the daddy knows best theory at all. In fact, it kind of suggests the opposite. The discipline of having to pay a regular dividend actually correlates with better future performance. It's a sign of a healthy, confident company, not something holding it back.
Okay, so if managers don't want to pay dividends, what about stock buybacks? In theory, they're a great idea, right? A tax-efficient way to return cash to shareholders. You reduce the number of shares, so each share left is worth more. But in practice, well, the story is often much, much darker.
So let's use Oracle as a case study here. In one single year, that company spent over $5 billion buying back its own stock. Now, to put that into perspective for you, that was more than half of their entire revenue that year. I mean, that is a gigantic amount of shareholder money.
Okay, now look closely at this. This is where it just gets outrageous. In that same year, Oracle was issuing new stock to its own insiders and employees at an average price of about $3.50 a share. Then it turned right around and used shareholder cash, your cash, to buy shares back on the open market for an average of over $18. Just think about that for a second. They sold low to themselves, and then they bought high from the public using your money. Does that sound like a strategy to make you, the owner, richer?
I mean, from an owner's point of view, it makes zero sense. It's the exact opposite of what any sane investor would do. Buy low, sell high. But it makes perfect sense once you realize there are these powerful, kind of hidden incentives at play for the management team.
It's really a brilliantly engineered system for them. Management gives themselves millions of cheap stock options. Now, all those new shares would normally water down the value for everyone else. So, to counteract that, they use company money, your money, to buy back shares on the market. This keeps the stock price propped up and makes their own compensation look great. And the cherry on top? Paying a cash dividend can actually lower the value of their stock options, giving them yet another reason to hoard cash instead of giving it to you. It's a massive conflict of interest.
So, right about now, you're probably asking, okay, this is crazy. How on earth can I, just a regular person, spot these kinds of shenanigans? Well, Graham pointed us to one document that is your single most powerful and most ignored tool, the proxy statement.
Every public company is required by law to send one of these to every single shareholder. And let's be honest, they're usually dense and boring, which is exactly why almost nobody reads them. But you need to start thinking of it as your own personal early warning system. All the conflicts of interest, the shady deals, the ridiculous pay packages, they have to disclose it all right in here. Let's take the tragic case of Enron. All the warning signs were flashing bright red, right there in the proxy.
If any investor had just bothered to read Enron's 1999 proxy statement, they would have found a little section called Certain Transactions, and it described a very peculiar arrangement. An arrangement that should have set off all kinds of common-sense alarm bells.
That's right. The proxy statement said in black and white that Enron's own chief financial officer was also the guy running these outside partnerships that were doing big deals with Enron. So you have the CFO sitting on both sides of the negotiating table, and the next logical question for any owner is just completely obvious.
He can't do both. It is physically impossible. He's either working for the shareholders or is working for himself. It was a profound, jaw-dropping conflict of interest. And here's the kicker. The board of directors approved it, and it was disclosed for any owner who actually bothered to read the documents they were mailed. The clues to the entire disaster were right there in plain sight. So the lesson from Graham, from this whole dividend debate, from what Oracle did with buybacks, and certainly from the collapse of Enron, it's crystal clear. It is time to stop being a passive, sheep-like shareholder and start acting like an intelligent, vigilant owner.
And here's the bottom line. This isn't rocket science. These are your fundamental rights, and they are your most powerful tools as an owner. Read the documents they send you, actually vote on the issues, and if something looks fishy or just doesn't make sense, speak up and demand a clear answer. It is time to use the power you already have.
You know, Graham's wisdom is just as true today as it was more than 70 years ago, maybe even more true. The act of owning a stock requires just as much intelligence, just as much care and judgment as the initial act of buying it. Your job doesn't end when you click that confirm purchase button. In a lot of ways, that's really when the work begins.
And really, that's the main takeaway from all this. You have to remember, it's not their company, it's your property. The board of directors work for you. The CEO is your employee. So the final question isn't for me to answer, it's for you. You are the owner. What are you going to do about it?
Welcome to The Explainer. Today, we're going to get right to the heart of what is, and I'm not exaggerating, the single most important concept from probably the most influential investment book ever written, Benjamin Graham's The Intelligent Investor. We're going to cut through all the noise and focus on the one central idea that Graham himself believed was the absolute bedrock of success.
You know, it's interesting. Graham doesn't start his lesson with numbers or charts. He starts with philosophy, with this ancient piece of wisdom. He's reminding us that everything, and I mean everything, is cyclical. The crazy optimism of a bull market, the soul-crushing despair of a bear market, it all passes. Getting that into your head is really the first step to building the kind of emotional strength you need to be a successful investor.
But if this too will pass is the wisdom for life, Graham believed these three words were the secret for the markets. This is what he came up with after a lifetime of work. I want you to really let that sink in. He said if you could boil down the secret of sound investing into just three words, these are the words. If you forget everything else from his work, this is the one thing he'd want you to remember.
Okay, so here's the game plan for our explainer. First, we'll unpack what this three-word secret actually is. Then, we'll see how it acts as a much-needed cushion against a future that, let's face it, is totally unpredictable. After that, we'll talk about the biggest risk in investing, and trust me, it's probably not what you think. From there, we'll draw a really clear line between investing and speculating. We'll look at the real-world proof, how this idea created a whole group of legendary super investors. And finally, we'll boil it all down into 4 principles you can actually use.
So let's get right to it. What is this powerful little motto that a lifetime of successful investing is built on? What does margin of safety really mean when the rubber hits the road?
At its heart, the idea is incredibly simple, but don't let that fool you. It's profoundly powerful. It means you don't buy a stock just because you like the company or think it's going to be huge someday. No, you only buy it when you can get it at a real bargain, a price that is way, way less than what your own careful, conservative math tells you the business is actually worth. That gap, right? That discount between the real value and the price you pay, that is your margin of safety.
So how does this work in the real world? How does it build this protective cushion we're talking about? Well, Graham, in his genius, makes this super clear by starting not with the complicated stock market, but with the much simpler world of bonds.
So picture a railroad company. For its bonds to be seen as truly safe, its profits shouldn't just cover its interest payments. They should cover them by a huge amount. Let's say 5 times over, year after year. That extra chunk of earning power isn't just icing on the cake, it's a buffer. It's a massive cushion that can absorb all kinds of unexpected problems. If a bad recession hits and the company's earnings get chopped in half, who cares? It can still pay its bondholders without even breaking a sweat. That extra cushion is the margin of safety you can actually see and touch. Same thing on the balance sheet. A business worth $30 million that only owes $10 million? Well, that's a $20 million cushion protecting those lenders.
And here it is. This is the real magic of the whole concept. This should feel like a massive weight off your shoulders. You don't need a crystal ball. You are completely freed from the impossible job of trying to perfectly predict what's going to happen next quarter, or what the Fed is going to do, or what some competitor is planning. If your margin of safety is big enough, a whole bunch of bad stuff can happen. Bad luck, bad management, a bad economy, and you can still come out okay. It's a buffer for error. It's a buffer for uncertainty.
Now, when we switch over to stocks, the same idea holds true, but we apply it a little differently. See, with a stock, you're an owner, not a lender, so you're taking on more risk.
That means your protection can't just be that the company can pay its bills. Your margin of safety is found when the company's earning power, the profit it's kicking out compared to the price you're paying, is way, way higher than the safe, boring return you could get from a top-quality bond. That extra potential return is your cushion. It's your reward for taking the risks of being an owner.
But Graham is quick to throw out a pretty stark warning. The danger of getting your math wrong on a company, or even paying too much for a great company, that isn't the biggest hazard an investor faces. The most destructive risk in all of finance isn't found in the market at all.
The legendary financier J.K. Klingenstein, after a long, successful career, was asked to boil it all down to one piece of advice. He didn't talk about complex strategies. He just said, don't lose. It sounds almost too simple, right? But it's based on the brutal math of compounding. If you lose 50% of your money, you need to make 100% return just to get back to even. The first rule of the game is just to stay in the game.
And let's make this painfully real. JDS Uniphase. It was one of the darlings of the dot-com bubble. Everyone was convinced it was the future. If you got swept up in all that excitement and bought the stock at its absolute peak in March 2000, even if the company then managed to grow at a pretty good 10% a year, it would have still taken you over 43 years just to break even. An entire investing lifetime just gone, poof, wiped out by one big mistake.
And this brings us right to Graham's most profound insight. Real financial risk isn't about owning stocks that go up and down. The real risk is in your own head, in your own behavior. It's the risk of giving into greed when everyone's euphoric, or giving into panic when everyone's terrified. It's the risk of not doing your homework and, most of all, not demanding that margin of safety before you act. The biggest threat to your money is staring right back at you in the mirror. This leads to a really fascinating way to think, which comes from the philosopher Blaise Pascal. His argument was about believing in God, but it applies perfectly to investing. He said you have to obsess not over how likely you are to be right, but about what happens if you're wrong. You might think there's a 95% chance a stock will go up, but if that 5% chance of being wrong means you lose everything, it's a terrible, terrible bet. The margin of safety is your tool for controlling those consequences.
So this intense focus on protecting yourself from disaster, it creates this fundamental dividing line in finance, a difference that Graham insisted you absolutely had to understand to be an intelligent investor.
For Graham, these words were not interchangeable. An investment is something that, after you've done thorough numbers-based analysis, promises your original money back and a decent return. Anything else, anything that doesn't clear that high bar, is speculation. See the difference? Investment is businesslike, it's based on math, and it's all about not losing. Speculation is based on feelings, on trying to predict the future, and it's all about chasing big gains. The bright line between them? The clear, undeniable presence of a margin of safety.
Graham's roulette analogy just nails this. A player betting on red has the odds slightly against them every single time. If they try to diversify by betting on more numbers, they don't lower their risk, they just make it more certain that they're going to lose. But the house, the casino, they have a tiny but constant mathematical edge on every single spin. For them, diversification across millions of spins makes their profit basically a guarantee. An investor who demands a margin of safety is the house. Everyone else is just a gambler, crossing their fingers and hoping to get lucky.
Now, all this sounds great in a textbook, right? It's logical, it's prudent, but does it actually work in the messy, real world? Does this whole margin of safety thing actually lead to better results? Well, it just so happens that one of Graham's most famous students, a guy named Warren Buffett, answered that question once and for all. Buffett asks us to imagine this huge national coin-flipping contest. Everybody in the country puts in $1. Every morning, you flip a coin. If you call it right, you win $1 from someone who got it wrong. Well, after 20 days of this, just by pure dumb luck, you'd be left with about 215 people who happened to guess right 20 times in a row. They would have each turned their $1 into over $1 million.
So are these 215 people financial geniuses, or are they just, as Buffett calls them, lucky orangutans? The academics would just dismiss it as a statistical fluke. But, and here's the twist, what if you did some digging and you found out that a huge number of them, say 40 out of the 215 winners, all came from the same tiny little town? You'd immediately know something was up. That's not random. You would get on the next flight to that town to figure out what in the world they were doing.
And this, Buffett says, is exactly what happened in the real world of investing. A completely disproportionate number of the most successful, market-crushing, long-term investors all came from one intellectual village. They were all students of or heavily influenced by Benjamin Graham. Their success wasn't luck. It was the direct result of using the same mental toolkit, with the margin of safety sitting right at the center of it.
And this Buffett quote just perfectly captures the whole philosophy in practice. You don't try to be clever and buy a business worth $83 million for $80 million. That's cutting it way too close. No, you look for the massive, obvious bargains. The bridge analogy is perfect. You don't build a bridge that can just handle the load. You build one that's so over-engineered with such a huge buffer for error that almost nothing could possibly go wrong. That's the margin of safety.
Okay, so we've covered the theory, the psychology, and the real-world proof. So how do we bring this all home? How do we actually apply it? Graham believed that at the end of the day, intelligent investing is just investing that's run like a business. He left us with 4 simple but incredibly powerful business principles to guide us.
First, know what you're doing. In other words, understand the businesses you own. They aren't just little blinking symbols on a screen. Second, don't just blindly hand your financial future over to somebody else without keeping an eye on them. Third, and this is the big one, don't put your money into anything unless a reliable, conservative calculation shows a decent chance of profit. Your decisions have to be based on arithmetic, not on hope or a hot tip. And finally, once you've done the work, once the numbers give you conviction, you have to have the courage to act on it, especially when everyone else is running for the hills.
In the end, Graham frames this whole thing not as some game to get rich quick, but as an intellectual adventure. Yeah, it's a journey into an uncertain future, but it's one that doesn't require you to be reckless or just have blind faith. If you're armed with this core concept of margin of safety, you have a compass. You have a tool to navigate that uncertainty, not with gut feelings, but with prudence, with discipline, and with a real quest for understanding.